to this computer. So it should be recording now. This meeting is being recorded. All right. Again, so welcome everyone. This was official. I mean, we've already started, but the recording just started. So we will get started with the part one of reading the financial statements. Now, the way we're going to be doing this is by looking at the financial statements of DMart. I'm sure you guys would have heard about DMart in your day-to-day experience. Let me just go ahead and share my screen from the iPad. Bum, bum, bum. Okay, I think you should be able to see this financial statements on your screen now. Yeah? Yes. Okay, great. So for those of you who do not know, every publicly listed company, which is to say that a company whose stock you can go and buy in the stock market, is by law required to release their financial statements. Now, what are financial statements? This is essentially, for loosely speaking, it's some sort of a diagnostic tool for businessmen or for finance enthusiasts like us to kind of understand the business purely from numbers. Right. So similar to your diagnostic reports like ECG, etc., that you get in the medical field. Zoom in, please. Yeah, I will zoom in. Don't worry. We will go one by one. So if you can't read the screenshots right now, that's on purpose. Also, just wanted to confirm if the recording for this session would be available. Yes. So, okay. So carrying on. So there are three main financial statements. The first one is called the balance sheet. Let's start with the balance sheet. This is the balance sheet of DMart. I hope it's visible now. What do we mean by balance sheet? Essentially, in a business, there is a fundamental equation called the equation of balance, which says that assets are equal to equity and liability. One second. Is my screen still visible or did it just go away?
It just go away.
It just went away? Okay, fine, never mind. Um, I think it's good. Well, here you go. Technical errors should be back again. Is it visible?
No, not yet.
Okay, amazing. Just give me a second, huh? Da-da-da. Yeah. So we were talking about the equation of balance, which is essentially assets equal to equity plus liability. Now, what do we mean by assets? Assets are basically the resources that a company uses to generate revenue for themselves. So if I am, let's say, hypothetically, Printo, I'm the CEO of Printo, all the printing machines that I have will be assets for me. Equity and liabilities. Let's start with liabilities first. Liabilities basically mean obligations that you owe to other entities. This could be banks where you've taken some loan from banks and you have to kind of give them back the loan, or it could be some other like lease agreements, etc. Right? And the remaining, whatever is left, is basically equity, which is the amount of money that the owners have put in initially and kind of sustained earnings. So it's basically the ownership of the company. We will go line item by line item, and this will become more clear as we understand the balance sheet more, right? So for every balance sheet, it starts with assets on top. You will see that there is the first bucket called non-current assets. Now, non-current assets are defined as assets which cannot be liquidated in the next 12 months, which is to say that if in the event of anything happening, you cannot kind of get money from them in the next 12 months. This could be property, plant, and equipment, as rightly written, which is very self-explanatory, which is property, plant, and equipment. Then you have capital work in progress. It's a financial way of saying any kind of new facility that you are building, which is work in progress right now. It is not really an asset at the moment, but it will be an asset later on, right? So for each of these headings, you will see two values. On the very right, there is one value in 2024, and there is the same value at the end of the financial year in 2025, right? Before we say anything, let's look at the numbers that I've highlighted in the red. In the red, you will see that the overall assets for DMart are 24,891 crores, and the overall equity and liabilities added also come up to 24,891 crores. So this will always match for every company. By definition, your assets will match equities and liabilities. A weird request, could you please slow down a little? Yes, I will be mindful of that. Thanks for highlighting it. So we were talking about how assets, which is this number 24,891, always matches equity and liabilities. Now let's look at the breakdown of assets. So for DMart, you will see that the biggest bucket within this asset is this bucket of 14,102 crores called property, plant, and equipment. Now, this is surprising, right? Because you would assume that a DMart or a grocery player, the biggest asset for them would be groceries, your vegetables, your basically the inventory that they will have, the stuff that they will sell, right? But that's not the case, because if you look at the inventory's value, which is this value right here, 4,800, 4,805 crore. Let me just use the highlighter instead. Yeah. So this 4,000 value is much smaller than the 14,000 value for property, plant, and equipment. Now, can anyone kind of guess why this would be the case? Or kind of what inference we can make now that we have looked at this balance sheet? They're buying land for shops. That's a good guess. Yes. Essentially,
Basically, they lease out the shops, right? So like they lease out the shops and then they go for like that's what their business model is about.
you're getting there. The real answer is they don't actually lease out the shop, but unlike other players like Reliance Fresh, like Big Basket, they own their own shops. DMart, every single, not every, 90% of the stores that you see for DMarts are the buildings and the land. Both of them are owned by DMart. So that comes as an asset on their balance sheet. So property, plant, and equipment comes out to 14,000 crore, which is not the norm, honestly. If I'm a Reliance Fresh, I will not own the building that I'm operating under. I usually lease it out. There will be someone else who will be owning the building. And in that case, that figure, the lease will come under this bucket, which is called the right of use assets. The right of use assets. That's essentially a finance way of saying I have the right to use this property. Or in other words, I am kind of leasing out this property. But if you look at their right of use assets, it's 1,599 crores, which is like not even like approximately 10% of their PPE. So 90% of the stores that they have, they're kind of owning it themselves. And only about 10% is where they're leasing. And a director of a DMart didn't need to tell me that. I didn't need to watch a YouTube video. I didn't need to do anything. I just had to go Google annual report for DMart, and then I would get this balance sheet. And just by looking at the number, I can make the inference that DMart, although it's a grocery or a kind of a retail player, majority of their assets are in land and buildings. Okay. So for DMart, placement of store plays major role. So they have to own some pieces of land and own it risk free from future high. Yeah, that's kind of a so this you're tapping into a good point here. Simply by reading the balance sheet, now I know a strategic advantage that the business has. What is the advantage? For DMart, the advantage is because they own their land and the buildings, not only will they appreciate in value over time, their rent cost will not go up. Unlike other players, if I'm a Reliance Fresh, my rent will probably increase by 5% every year at the very least. So, under my obligations, you will see like an upward trajectory. So, I will need to kind of match my profitability also to go up year on year if I am to make money. But for DMart, they don't have to worry about it because their rent cost will not go up since they own the thing. Do we take the value of the entire building or the rent I'm paying? Say a building has total value 10 rupees. Okay. I pay 5 rupees rent. My right to use asset is 5, right? Yeah. You don't care about the value of the building. It's your right of use asset will, if assuming you're not owning the building, if you're leasing it out, then you don't care about the value of the building. You just care about how much lease you're paying or how much your obligation to pay back to the person who's lending it to you. And that will come out as right of use asset. Great. So far, so good. The pace is better now. I'm going a little slower. I hope it's more understand. Okay, there are people in the waiting room also. Ba-ba-bum. Let me just admit them. Yeah. So I hope this pace is better. So we were talking about assets and current assets currently. no, non-current assets currently. We covered property, plant, and equipment. We know what capital work in progress is. We also know what right of use asset is. Investment properties could be other properties. Now, so every with next to every one of these line items, you will also see a note, which is this value right here. So in an annual report, you can also go and check in this note, what does this bucket really mean? Because for different companies, this number means different things, but they have some properties which they have invested, or they could have leased it out to other people, like they owning equal to no rent equal to less fixed cost equals to makes it easier to give discounts. Okay, in next so this is, I appreciate you guys leaving or making the chat active. By all means, go for it. In case you have a question, start with an all caps word called question so that my eyes can go there and I can address it. Otherwise, it's just for others to kind of interact with it. Okay, great. So investment properties we have covered. Intangible assets worth 18 crores. What are intangible assets? As the name says, they are intangible. You can't really feel them. This is usually like the brand value, the logo value. For Coca-Cola, intangible assets are quite high on their balance sheet because they believe that there is a real value to the brand they have. DMart has only accounted for 18 million rupees, 18 crore rupees. Okay, financial assets, investments, other. So not all of these are really important to us. We just really want to look at the trend. The trend here is they have 24,891 crores in assets. Out of that, 18,700 crores, which is basically this number right here. This is what I'm reading out. This number, 18,700 crores, are in non-current assets. And the remaining 6,000 crores are in current assets. Current assets basically means assets that can be liquidated in the next 12 months. Why is that important? Because every business, can you zoom in a little bit more? Okay. So because every business, as we will see later on, also has current liabilities, which is basically this bit. Current liabilities means those loans that the business has to pay in the next 12 months, and not meeting those loans will kind of result in some form of bankruptcy for them if they miss multiple payments. So it's important that your current assets are always greater than current liabilities, or if not greater, the ratio. This is called the current ratio. Very simple to get. You just divide the current liabilities by the current assets. I have, by the way, don't worry if you're not getting all of the notes. I will share this thing as is, and I have put the notes, some of these teaching notes here. So current ratio is current assets divided by current liabilities, and they help in covering near-term obligations. So in this case, you will see it's close to 3, right? Because roughly speaking, this is 2,000 crores. Roughly speaking, this is 6,000 crores. Current liabilities 2,000 crore, current assets 6,000 crores. So they can kind of pay their current obligations 3 times, which is a very good reason, right? Now, which shows kind of a healthy balance sheet. Now, the CEO of JP Morgan Chase, Jamie Dimon, he's well known because JP Morgan Chase was one of the only banks to kind of withstand the financial crisis of 2008, while others were kind of falling to the mortgage-based security crisis that happened in the housing market, right? The reason they did that is because the companies or the assets that they were invested in, they really made sure that the balance sheet, what he likes to call it, is this word called a fortress balance sheet. A fortress balance sheet essentially is a rock solid. It's like a fort that you can't penetrate. And it's going to withstand the difficulties of time. So if you look at DMart's balance sheet, the reason I chose DMart and not other companies is because it's a beautiful balance sheet that really shows how financially strong this company is. We've already spoken about how they have great PPE, which is plant property and equipment. We know that their current ratio is greater than 3, so they can meet their current obligations more than 3 times, and overall their debt obligations are also low. Okay, so now let's come back to current assets. So non-current assets we've deep dived. Current assets, as I said, liquidable in the next 12 months. Now, this will include inventories, which is a big portion, 4,800 crores. After that, you will have financial assets, which are essentially your investments, trade receivables. What are trade receivables? Trade receivables is when you sell something, but you do not get the money immediately. The person who's buying it from you is probably going to pay you in the next 30 days, in the next 60 days. So it's a receivable. You will get it in the future. You don't have it now, but you can still kind of write it as an asset on your balance sheet because you know it's going to come. So when you buy something on Flipkart or Amazon for EMI, this kind of goes into trade receivables on Flipkart's balance sheet. Okay, so cash and cash equivalents, this is very important. which is essentially the physical cash, the real cash that is kind of lying with the company, which in this case is around 330 crores. Now, isn't that surprising for a company whose overall asset base is 24,000 crores, close to 25,000 crores, only 300 crores are in cash. Everything else is like other assets, and it's important to have a higher, question. Share screen also has your video obstructing the view. Can you adjust that? I think I have adjusted that now. What would be a good current ratio ideally for companies? That's a good question. It depends on the sector that you're in. There is no general answer for any company. So some of these companies, which are asset heavy companies like steel, etc., they can have a higher current ratio also because they have underlying assets. But for 2:1, ideally, yeah, I mean, as I said, it depends upon the company. The lower it is, the higher it is, the better it is for the company because that means that they have greater assets to kind of pay off their current obligations. Great. Now we will. So far so good, right? I hope so. This is a lot of finance can get very number heavy, etc. Which is also the reason why, if you look on YouTube, the content that I make is. I mean, I shy away from making a lot of technical content. Still, some amount of technicality is getting because you need that for appreciating. But for this class, we will not shy away from any technicalities. Let me know if this is too technical. If you want me to kind of uh, simplify it even more, or this is fine. Okay. Now, question, what does less cash and more property imply? Is it good or bad? You want to definitely have a good amount of cash. Again, there is no real, so everything depends on the industry. The way you kind of get this is say you ask Claude to give me 5 balance sheets of top listed companies in this sector, say real estate, for example. You give Claude this prompt, Claude will probably go and scan a bunch of annual reports. It will come back to you with snapshots of the balance sheets. Now ask it to calculate the current ratio or give me a trend line of how much cash reserve do other players have. So it will give you like a graph of sorts, which will show for every company how much cash there is. So you can kind of see a trend that in this industry, typically players like to keep 10% of their overall assets in cash, hypothetically speaking. There could be some players which are very cash poor. They have only 2 to 3% cash, and the rest is, which is a kind of a red flag. It's good to have more cash. It's a red flag to have less cash. Got it? Is cash considered all liquid? That is just bank balance or more complex investments too. So cash is typically, we say cash and cash equivalents. So it's not always just the money that is sitting in your bank account, current bank account that you can use, but also money that you can very easily trade and get highly liquidable assets. So this could be money that they have invested in stocks, right? Which are, they can withdraw the stock on a day, or a mutual fund, which can kind of be withdrawn in like 1 or 2 days time. Things which are highly liquidable will come into cash equivalents. Okay. Now, this actually is a good segue for me to kind of also show you this other balance sheet. I also wanted to keep another balance sheet. This is the company we all love, which is Apple, which is the device we're kind of seeing this on as well. And here also, again, it's so fascinating to see that any company you can kind of deep dive just by Googling and getting their balance sheet. Here you will see that's a much simplified form of a balance sheet compared to DMART, just black and white, classic Apple. Also, they follow a very good norm, which is to say they start with current assets and then they move downwards to non-current assets. Usually, it's a good practice to list your assets in decreasing order of liquidability, right? So you will always start with something that is highly liquidable. You can cash and cash equivalents is the most liquid asset that they have. And the lower you go, you will see that these are not easily liquidable. Like property, plant, and equipment are hard to kind of liquidate. Okay. But obviously, our guys here at DMART really don't care that much about it. They started with non-current assets, and the first thing they said was property, plants, and equipment. Which if you're an accountant, you would be like, yeah, this is not the best practice, but we don't really care. This is just some small nuance that I wanted to highlight. Let's go back to this balance sheet, right? Now, you will see that Apple has a good amount of cash. They have around $45 billion in cash out of their overall $379 billion of assets, right? Where am I reading these numbers? You can see, right? The red ones are highlighted, and I'm just simply reading it off of this. So this is the 45 million number. This is the 379 billion number, right? You can also see something called as marketable securities. Marketable securities are essentially just investments that Apple has made in the financial markets. Securities, whenever you see securities anywhere in finance, just think of it as an investment that an entity has made. They like to call it security because it is secure. You will kind of get the money back. That's the kind of idea behind naming something security, but it is essentially an investment and marketable because you can go ahead and trade it in the market. So these are also liquidable. But you will also see that marketable securities, much better. You will also see that the marketable securities are coming up in non-current assets as well. How are we doing on time? Already half an hour gone, and I'm only speaking about the balance sheet. This is going to be a long session, guys. I hope you buckle right in, and I won't mind if you leave in the middle because attention span is a scarce currency right now. But yeah, I'm reading the chat as we go along. This is the first session for all of us. So really excited and curious to see what we can do better as we go along, right? So marketable securities also comes up under non-current assets, which is funny to me because I have really usually not seen the same header kind of come up both in current assets and in non-current assets. But the
एक
reason,
बार बिल्ली के बारे में पूछ लेगा.
sorry. Or was that just I'm assuming that's probably a blunder. Doesn't matter. So the same header coming up in both non-current assets and current assets is rare, is what I wanted to say. But it may happen that some of the securities that are marketable are not easily liquidable. These could be things like treasury bonds. So treasury bonds usually have a 5-year, or like, depends upon how big the treasury bond is. If it's a 10-year bond, you will essentially get the whole money back in and the interest in 10 years, right? So they're non-current assets. So that's probably why it's happening. But so far, what we've kind of discussed is the equation of balance, which is assets equal to liabilities plus owner's equity. We have discussed within assets, there are two kinds of assets, current assets and non-current assets. Current assets are assets that are liquidable in the first 12 months. Non-current are liquidable not in the first 12 months. Similarly, for liabilities, you have short-term liabilities, or called current liabilities, and non-current liabilities, also called as long-term liabilities. You essentially want to have a current ratio greater than 1, where your current assets are greater than your current liabilities. And we've also discussed briefly what these different headers inside this balance sheet mean, what do they stand for, and we've also discussed kind of spotting the trend by looking at the biggest value and what it tells us about the business. All right. Would suggest to mute for all viewers and raise hands to unmute. Thanks, Vignesh. Your suggestions are spot on. Question: is there a mandated template for assets, or is it dynamic based on company list, based on what they own, or cover all aspects? US was so this is getting into very like technicalities of it. Like as an accountant, what gets classified under what asset bucket? We don't really care. I mean, if you watch my rating finance jobs videos, you would see that I put the job of a CA, or at least a CA in a big four firm, in like one of the lowest categories. And the reason for that is because of this like book stuff, right? Like we are builders. We want to get what the numbers really mean for us. What is the insight? The insight, or the so what, is the most important thing for us. We don't really care about if this by legislation will go under this bucket or that bucket. I'm sure there are answers. It's a still good question. There are no bad questions. But to answer it, I really don't know what exactly the mandate for classifying assets are. Question: is cash considered liquid or just okay? So I've answered all the questions. Is being virtually debt free always value accretive? What's the opportunity cost for not leveraging? That's a good question. I sense some sort of finance background in the way you've phrased it. Value accretive is a nice way to put it. I would say that's not a good idea. You don't always want to be debt free. Debt is not a bad thing to have. As long as you have good amount of debt, it's nice. That's the reason why in finance we don't really use the word debt that often, but instead we call it leverage. Leverage, basically, from physics, you borrow this concept where you have a lever, right? If you press on one thing, the other part of the lever will kind of go up. So that's where leverage comes in. You can get money. Debt is the cheapest form of money, right? Equity is the most expensive form of money because you're giving a part of your business. Debt is just you getting the money and you have to pay it back in some interest, usually 10% or whatever the amount is, depending upon what the loan is. But debt is cheap money. So you kind of want to use that leverage. You want to have your business which is kind of levered a little bit, but not a lot of debt. So you just, the way you calculate the number that you really want to look at, which is debt to equity. Debt to equity basically means that, okay, now we're kind of going ad hoc, but I think this is still covering a lot of the concepts that I wanted to cover later on. So debt will come up later in the liabilities side. So if you look here, where is our bad boy debt? So lease liability is not really debt. Maybe these guys, okay, DMart is DMart, bro. DMart owns their own buildings and he's done some crazy stuff. But let's look at Apple here. Apple has this thing called term debt, right? So this is your debt. Then you also have some term current liability debt. If you add both of these guys up, and that becomes, yeah, others are other liabilities. So if you add both of these guys up, which comes out to be say 87, you can call it 88, right? And you divide it by the equity, which is which number? Which is this number, the blue number, 88 again. So this is coming out to be approximately 1, right? Which is good. So a debt to equity ratio of 1 is fine. Ideally, you want to have it less than 1, where you have more equity, less debt. But there are industries where you can have more debt than equity also, like the steel industries. Any asset heavy industry usually will have a higher debt to equity ratio, right? But you definitely don't want a very high debt to equity ratio. And these things don't even look like numbers. I should have used a pen, but it's fine. Looks cute though. So this is what's up. So we've covered that question. Now, where was I? So you got the answer, right? Debt free is not really always a good idea. Some amount of debt is good. It's leverage. It helps you to get more revenue. What's the opportunity cost? Depends upon the industry, blah, blah, blah. Question: how do you address whether a business is financially healthy or not? Are there any industry averages or benchmarks? This is exactly what we're discussing right now, right? Which is, for spotting a healthy business, you want to kind of check these 5, 6 things. What are these things? Number one, is their current ratio greater than 1? Right? Do they have enough current assets to pay off their current obligations? That's number one. Number two, what is their debt to equity ratio? Are they over levered? That's bad. Are they under levered? That's also bad. For each of these cases, it's always like it's kind of how you approach a financial diagnosis, where you don't just look at one balance sheet, you look at the trend of balance sheets over the years. So right now, the reason even in accounting you will see two numbers kind of given to you is to give you some sense of what the direction of the financial trajectory of the company has been. So you look at the progression of these ratios over time to see if the company is getting better or worse. Second thing, you also compare it with an industry average, where you take the average of top 10 players in the industry, use that as like the gold standard for the industry, and then compare the balance sheet with them. Got it? Great. So DMart's inventory turnover is among the best in Indian retail. What balance sheet and P&L signals would tell you if that discipline is weakening apart from what we discussed? Inventory turnover will have to do with cash flows, which is like the third financial statement that we will discuss. So there are these financial concepts called DSO, DIO, which are days of sales outstanding, days inventory outstanding, and stuff like that, which is basically kind of giving you an idea of how fast or what is the turnover for the inventory for the retail player. Usually you want it lower as possible because you want to be a cash flow positive company. But from the balance sheet, barring these ratios, there's not much you can look at apart from the trend in inventory values, etc. But we'll get to the cash flow statements. Okay, a lot of questions. Great. So people are listening, people are engaging, which is a great sign. I might need to drink some water though. It's a 40 minute हो गए हैं. By the way, at the end of this course, at the end of this class, I will obviously share all the resources that we're discussing right now. All of these, and later on also you will see a bunch of other things which will be all shared to you. The recording will also be shared to you. But I will ask you to leave me the review in a Google form link that I will be sharing. Give me your honest review. How did you feel this class was? How would you rate it on a scale of 5? And what can we work on? Yeah, and please also attach your photo if possible. That's not a mandatory question, but those reviews will also go up in the updated website for Dhandha School in the future. Great. So let's come back to this thing. Do you have a slide coming which covers what things we have covered till now, just to make notes and help my mind revise? I don't have a slide which covers all the thing. I mean, the Notion page that I showed you was a breakdown of all the lessons, so I can kind of show it again. We're still at part 1 of the session. There are 3 main modules in today's session. One is understanding financial statements, which is what we're doing right now. Second is understanding basics of stock market. And third is understanding the VC landscape. So we're in module one right now. I would say we're 33% in. Okay, great. So now let's come to equities. So in equity, you will see two values. One is equity share capital. And the other is other equity. Basically, equity share capital is the amount of money, sorry, is the amount of money that the owners had put in initially when they were starting the business, right? So this is around 650 crores. Other equity basically means all the retained earnings of the business over the years. So every year, I mean, doesn't have to be the case. There are a lot of businesses which are VC funded, I mean, almost all when they're expanding, which are loss making. So your equity will kind of take hit, or you will have to raise money to kind of fund the business. But assume that it is a nice dhanda. This dhanda is doing well. It's generating money year on year. So that money that is left goes and literally goes and sits here, which is your other equity. It's called retained earnings. You kind of retain your earnings over the year, and this value keeps going up. So you will see last year it was 18,000 crores. Now it's 21,000 crores, right? So it's kind of, so DMart made 3,000 crores and retained earnings in that one financial year. So that's your equity side. Now let's look at liabilities. And by the way, it's such a strong balance sheet. Like, look at the liabilities. It's just 2,000 crores compared to 22,000 crores of equity. So they owe just 10% off. Like, they can pay their debts 11 times over using the money that they have in equity, which is amazing. Like, this is not always the case. If I go to Apple, we will have what's up with Apple? Yeah. So you will see that owner's equity is 88,000 crores. I mean, 88 billion US dollars. And the liabilities are $291 billion, which is not, I mean, it looks scary because you have more liabilities than you have equity. It's not that bad. I mean, Apple can be leveraged well because they have a lot of these assets sitting where they've invested back in the market. But that's usually the trend. Like, usually you will have probably less equity than liabilities, but DMart is just, this guy has built up the best dhanda, I would say, financially speaking, at least. Okay, great. So we have covered equity. Now, can you please explain equity again? So DMart debt to equity is less than 0.1. Yeah, you can say that. You can say that. Although I don't see debt exactly here. Even the other liabilities are not really debt. These are lease liabilities. So lease liability is not a debt. Other financial liabilities, I will have to read this note called 18 to see what that liability is. But I don't see a clear debt as I saw in the Apple studio. But let's just assume, I mean, hypothetically, that all the liabilities are debt. Even in that case, their debt to equity is less than 0.1. Can you please explain equity again? Brother, what's your name? R13XG1403_2501885654. Anyways, so the equity, this is the term Shark Tank loves, right? Like, if you go to an investor and they'll be like, I want 5% of the equity and I'll give you this much money. The way a common person will understand this is it is a reflection of how much ownership you have in the company. But that's very loosely speaking, right? Financially speaking, there are a lot of nuances. Within equity also, you have these things called preferred shares, which give you more voting rights about the decisions that the companies will take. One would argue that's greater ownership of the company, even though you have less shares, etc. So that's all of that. But for this financial statement reading perspective, equity is the money that the owners own. It's not money that they owe to lenders. मतलब ये लीज लाइबिलिटीज नहीं है आपकी, ये बैंक को मनी ओन ही कर रहे हैं. जितने भी शेयर होल्डर्स हैं डीमार्ट के, दिस इज द मनी दैट दे own. That's the way to kind of, that's the way to see it. Question: say we are a tech-based company, under which header shall the value of my tech be shown in the balance sheet? Also, how is the valuation done? The last part, the valuation done, I mean, that question is why investment bankers earn crores of rupees, right? Like, valuing a company is not a straightforward task. The way you do it is, there are three main ways to do it. One, and the most fundamental way to do it, is kind of the future discounting cash flow method, where you discount future free cash flows by the by the cost of capital, or the weighted average cost of capital. I made a video about it called The Most Fundamental Concept in Finance, where I talk about how at the heart of all of finance is essentially discounting future cash flows. But we're not discussing that here. As I said, it's not a CFA class. But so to answer that valuation question, the fundamental method to value a company is by a discounted cash flow method. If you are interested, you can Google more about it. But for this purpose, the way you can also value a company, if it's publicly listed at least, is simply by looking at their market capitalization. What that is, we will talk about it in the share when we talk about stock markets. But that number is the value of the company. And if you want an easier way to kind of calculate the value of a private company, which is not publicly listed, you take a multiple from the company which is publicly listed in the same industry, and then you multiply that multiple with revenue. Okay, but that's the last part of the question. So I'm not shying away from questions, but I would also like to highlight that this is probably not relevant to this module that we're discussing right now. Say we are a tech-based company, which header. So again, this is similar to how you would classify, right? That's the accountant's worry. We don't worry about it, but it will come under assets. So a tech company also, if it's a software company, you will see a lot of intangible assets here. There will be a header called intangible assets, which is your IP, your intellectual property, that will come up as an asset. Okay. Okay. Like for benchmarking makes sense for a new question. How can you please suggest a finance book to understand concepts? Just read Dhandha School and the stuff that I will share. I don't follow any book. I'm being very honest. I feel like financial books are graveyards for curiosity. The way they write it is too complicated. They just make it a subject which is already like it's eyeing for simplification, right? Like if a physicist approached finance, he would always go by first principles and he would always want to simplify things instead of complicating them. But people in finance love complicating stuff. It's the reason why they make money, right? Because if you can't understand what I'm speaking about, only I can do it. And that's how people make money in finance. So there's no book. You just go ahead with the notes that I have. Claude is your best partner, bro. That guy, they're really smart, these models right now. So you can kind of play around as much as you want. Whisper Flow, which is the company that I collaborated with the video that I released today. By the way, I had to pull an all-nighter to release that video today because the brand wanted it. And I also had this session. So I'm a little sleep deprived. And I don't know if you can tell or not. Really excited to see you guys, which is why energy is coming out. But you can use Whisper Flow and Claude together as much as you want. And you can really like not have to read any book as such. Like for benchmarking makes sense for a new company. All right. So far, so good. Now, let's carry on with our liabilities bit. So liabilities, you will have financial liability, again, non-current and current liabilities. We've already spoken about this. Lease liabilities are your lease liabilities. Deferred tax liability. This is basically tax that you kind of defer. You will pay in the future, but you still owe, stuff like that. Again, nuances, don't really need to care too much about it. There's another term that comes up here, which is trade payable. Trade payable basically means the money that you owe to the suppliers, you will have to pay them. It's payable in the future. So it's an obligation or it's a liability for you. And there are different kind of conversion days that the accounting standard or the government of India needs. So for micro and small enterprises, you need to pay them fast because they're small companies. You can't owe them a lot of money because their cash flow runs into problem. So they have to kind of legally bifurcate it, etc. We don't really need to care too much about it. So this is what we're looking at, right? So this is how you read a balance sheet. Now, I don't want you to be overwhelmed or scared when you see a balance sheet in the future. In fact, I want you to be people who really enjoy fiddling around and playing around with balance sheet. Like in your pastime, you should just go to Claude or go to Google, just random companies that you admire, Flipkart, for instance, or Zomato, for instance, or any company in any sector, just look at their balance sheet and really try to understand what does this tell me. And you will find some very interesting patterns. Within industries, current ratios change drastically. Debt to equity changes drastically. Your breakdown of non-current assets also changed drastically. So that kind of gives you more flavor. And the more you consume this, the stronger your vocab will become. So when you go and talk to someone, you are the industry expert then because you dive deep into the numbers and you're not coming from a random YouTube video like Think School, which will just broadly speak about like these 5 things, etc. Not to diss on Think School. They've done good work, but I feel like intellectually it can be more stimulating. We can also use Screener. Absolutely. Screener is a good for publicly. I was going to speak about that when I come to stock markets. But yeah, I would still encourage you to go and download it from the company's official website instead of downloading the annual reports from somewhere else. Simply go to Google, type annual report, it will come up. First result. It's a PDF. Every quarter they have to release it. So, I mean, annual report gets released annually, but every quarter they have to release financials. All right, so let me just go through it briefly to see if I've missed something. Blah, blah, blah. Cash and cash equivalents, trade receivables, inventory, PPE, goodwills, investments, trade, short-term borrowing, long-term borrowing, provisions. Provisions are money that they keep aside. It's a provision. So it could be for future applications, warranties, legal claims. A sudden spike is worth investigating. Yes, it's important. It could be because of a legal case. So if hypothetically speaking, I mean, I'm just giving an example out of my, I'm just thinking out loud. If Samay Raina was a company, if Samay Raina Private Limited was a company and all his finances were taken care of by that entity, then he would probably put some money aside in provisions. In the balance sheet, you will see provisions go up a lot. Why? Because he's anticipating a police case where he will have to pay a lot of money. So it's kind of overlooking or forward-looking money that you need to kind of set aside. That becomes provision. Equity side, equity share capital, which is a static face value of shares issued, exactly what I said. It moves when you issue more shares. Other equity, which is your reserves and surplus, is accumulated retained profits. That's also exactly what I said. Sorry, I could not attend, blah, blah, blah. It's okay, yeah. Don't worry about it. Current ratio. Current ratio was spoken about, debt to equity, goodwill as a percentage. We've also never read these ratios in isolations. Always benchmark against the same company 3 to 5 years, 3 to 5. Amazing. Great. Honestly, this is better than how my finance professor taught me in IIM Bangalore because I was so scared. If you go to a finance book and if you read a financial statement or a balance sheet, they kind of make a simplified balance sheet for you to understand. So they will cook up companies like Raj Mehta Private Limited sells groceries, and they will like, why do I need that? Just give me a real balance sheet. Show me really how it is done in the industry. But anybody, if you're from B school in this, you can kind of confirm this that they don't show you the real balance sheets and they're still kind of very archaic in the way. But anyway, we don't care about it. In Dhandha School, we go practical, we go real. So this is done. That's the first part. So balance sheet is done. Question. So balance sheet has to be the first thing to look at. Absolutely. And then come to income statement. Yeah, this is the order. Watch the latest latent episode. I didn't watch it. It was nice. I liked it, although there was a lot of awkwardness compared to what it was in first season. But I mean, Samesh is still Samesh, so he's really hilarious. And the Donald Trump guy was really amazing. It was really good. Actually, this is the reason why I probably didn't sleep last night. If I had logged in and worked, maybe I would have gotten 3, 4 hours more sleep. But I really wanted to enjoy also. So it was a good episode. Anyway, coming back to finance. So the P&L statement. Now let's look at the second statement. This is the statement where if you go to Shark Tank in the future, if one of you 100 guys, when you go and build a company, you'll go to Shark Tank for investment, you will be talking to them, telling them, I need 5%. I'm willing to give you 5% of my equity, but I need 10 crores of your rupees. And then they will ask you, okay, tell me about your gross margins, tell me about your EBITDA, tell me about this, that, etc. Right? That's all the numbers that come from a profit and loss statement. This is the statement that gets talked about the most when it comes to investor conversations, right? So it's important, and it's also I would say it's probably the easiest statements amongst the three. So it's also very easy to understand it, and you will learn more about this as we go along. So again, the first header of a profit and loss statement is obviously always the sales or your revenue, which is what you see here. So it is 57,000 crores. DMart sold a lot of stuff. So close to $5.7 billion. Right. So that's your first bucket. After that, you have something called other income, which is other income. So it's income which is not from revenue, but from return on investments that you have done. You could have invested some money, you got maybe like some percent interest. That is also an income for you. So that's usually very small. You add both of these guys up, you get total income, which is this number right here, 57.9 thousand crores. Then you start cutting down all the expenses. Now, what are the expenses? The first things first, the thing that you're selling, you have to buy it somewhere yourself. So that's called the purchase of stock in trade, which is 50,000 crores, right? Then you have some changes in inventory. If you already had some inventory, which is basically your final value minus initial value. So how much of the inventory you have used, so you did not need to buy it. So, oh, by the way, the numbers, is voice breaking for everyone? Is voice breaking? No. Gagan seems like a you problem, bro. Get a better network. Anyway, so you have stock in trade followed by changes in inventory. If you already have an inventory, so you didn't need to pay it for this year. So the numbers that you see in bracket basically means negative. That's the finance way of saying that something is negative. So you see negative 1,000 crore. Why is it negative? Because change in inventory means the final inventory minus the initial inventory. The final inventory had to be smaller than the initial inventory for it to be negative. What that means is they kind of sold stock that they had. It's pretty self-explanatory. I'm getting confused at the other way, but you get a negative number here, right? Because your final is lower than your initial. Doesn't matter. Point that I'm trying to elicit is appreciation from property, other income. That's correct. Point I'm trying to elicit is here you will calculate something called as gross profit. This is what you really need to understand. Gross profit or gross margin is the profit that you will achieve in a dream world. in your dream world, when you didn't have to have a company, you didn't have to pay any employees, you didn't have to pay any government for taxes, you didn't have to pay any bank for loans, you just had to buy something and sell something. There is no cost that you're getting in. That is your gross profit, right? Also called contribution margin 1 or CM1, right? Same thing. I like to use the word gross profit because it's more intuitive to me. But sometimes people ask CM1 and CM2, but CM1 is basically your gross profit, right? Now, in this case, how would I calculate it? I would simply look at, okay, 57,000 is their overall revenue, 57.9. So let's assume it 58. 58 is their overall revenue. Their changes in inventory is basically this number, which is 50.6. For this moment, I'm avoiding the changes in inventory. Let's keep it simple for everyone to understand. Simply purchase of stock in trade, which is 50.7. So 57.9 minus 50.7, which is basically 7.3, which is this number that you see here. Now I've divided 7.3 by 58, which is basically your revenue. What that gives me is 12.5%. That is their gross profit. So in a dream world, when DMart didn't have to do anything, they were just buying and they were just selling, they would be making around 13% gross profit or gross margin. Profit is the number, margin is when you express it as a percentage. So gross margin is 13%. This is the same thing as CM1. Obviously, we don't live in a dream world. Seems like a you problem again. Ruponja is also having fun, huh? Nice. So we don't live in a dream world. Things are more realistic. So here you would see, okay, actually, let me just give you a snapshot first before we dive there. There are basically three main things: gross profit, EBITDA, and net profit. These three are different from each other. The way they rank is in this order. Net profit, this is by the way a less than signer. Net profit is always less than your EBITDA, which is always less than your gross profit. The way I like to understand it is gross profit is the profit you would have made in a dream world where you would just buy something and sell it without even having a company, no overheads, nothing. EBITDA is what you would realize in an ideal world where you would have the company. Obviously, you will have employee costs, you will have fixed assets, you will have everything. But it's an ideal world where you don't need to pay anything to the government, you don't need to pay anything to the banks, etc. So that's your ideal profit. And then obviously, net profit is the real profit, where after you pay off for everything, what's the money that is kind of left on you? Ideal world equal to Dubai. But I mean, in Dubai also, it's just income tax is zero, corporate tax is not zero. So anyway, I got the joke. So gross profit, we've already calculated, which comes out to be 12.5% in this case for DMart. Now, for EBITDA or earnings, EBITDA stands for earnings before income, tax, depreciation, and amortization. For those of you who do not know the word depreciation and amortization, it is simply wear and tears. That's all it really means. I mean, depreciation happens for a physical asset, amortization happens for an intangible asset, but both of them basically means wear and tear. Anything that you have will over time deteriorate. I buy a TV today. That TV is going to work maybe for 5 years. After that, it will stop working. So every year, I will say that the value of my TV has gone down by 20% because over 5 years, it will be useless to me. Now, that 20% depreciation is what we call depreciation cost. It depreciated or it reduced in value. That's depreciation. If the same thing happens for an intellectual property, it's called amortization. It's just wear and tear. So if you understand it, EBITDA becomes very explanatory just from the full form, right? It's your earnings before income tax and depreciation. So basically, if I go back to the P&L now, so I had calculated till somewhere, where is my marker? Let's get a pencil this time, actually. Yep. And so I was still here. Then I will add your employee costs. I will add, actually, I won't add finance cost for EBITDA. Finance cost is basically the interest that you're paying to banks. Huh? I will also not add depreciation. Yeah, that's about it. So what will I do? I will look at this number, 3,883, which is your profit before tax. And I will add both this guy and this guy. Why? Because I have subtracted them for no reason. I did not, for EBITDA, I don't need interest and I don't need depreciation, but I've already subtracted them in the P&L, so I need to add them back. What does that do for me? Basically, it's 3.8. It's 3.8 plus how much is this? 750, 830. 830 is typically 8.3. That'll be 12.1. Oh, so this is 0.8. Yeah, my bad. It's 800 crore. So it's 0.8. This will become 16, 6, 1, 4.6. I have taken 4.7 in my calculations here, right? So you divide 4.7 by 58, you get 8%. So 8.1% is basically your EBITDA for DMart. This bit is clear? Okay, this is good. Question, okay, am I missing out some question? How are all the three financial statements related together? Like how a value edited in, for instance, cash flow statement becomes affected? Uh, I mean, okay, let me just tell you this. So you would see P&L, your changes in inventories basically come from your balance sheet, where you will have in inventories, two values of inventory, which is 3,700, 4,800. The difference of that will kind of show up here, which is like 1,000 something. But in general, this is different. P&L is different. I mean, some bits overlap. Change in inventory comes from, you can kind of tally it back to the balance sheet. And you can also tally your lease costs, which comes up as lease liability. But a lot of these numbers actually don't talk to the balance sheet, like your employee expense, your other things. So yeah, it's related. The way I like to see it is balance sheet gives me the health of the business. It tells me what is the balance really like. Are they asset heavy? Are they equity heavy? What's the split between assets? What's the split between the liabilities and all of that? P&L takes me their state of affairs for a business. How well are they conducting business? It tells me, are they profit making? If they're profit making, what is their margin? What is their gross margin? What is their EBITDA? What is their net profit? It tells me all of these things. Can we do this again, please? The calculation was a bit fast. Okay, sure. I mean, I'm here all day. It's 3 तो बज गए हैं. मैंने 3 घंटे का लिया था, but बीच में ब्रेक ले लेंगे, कोई नहीं. Blah blah blah. Oh, no, no. By the way, do you guys know finance with Charan with like the one? By the way, he has finance in his name, and my guy only talks about credit cards and some other stuff, and charges like a lot of money. People are making a lot of money just teaching like this, the kind of finance that actually is kind of useless for builders. But anyway, this is also recorded, right? If I post a snippet of this on YouTube, this will generate controversy and views. Be helpful. Which profit we should look at comps, comparative analysis, and companies' operating performances? Okay, I'll answer that. Calculation. So basically, let's go with the calculation again, right? Okay. Simply put, gross profit is your revenue. Let me get my pencil again. We have our revenue, which is 57.9 thousand crores. We subtract the cost of goods sold from that, which is exactly what I've written here. Revenue minus cost of goods sold, or basically the purchase of stock and trade. All of them mean the same thing. So this will come out to be 57.9 minus 50.7, or 7.3. Am I doing something wrong? No. 57.9 को मैंने 58 मान लिया है. Yeah, so that's fine, right? So it comes out to be 7.3, right? Now 7.3, this clip will go viral if posted. Yeah. Controversy तो मैं बहुत कर सकता हूँ. धीरे-धीरे. Everything slowly. All these the finance space in India is actually, I mean the finance space in the creator space actually needs a revolution now. But okay, so 7.3, this number you understood, right? Now we're doing the calculations again. 7.3 came basically from revenue minus COGS, and 58 is just the revenue, the initial revenue. You divide both of these guys up, you get this bad boy, 12.5%. Got it? So that becomes your gross profit or gross profit margin, also called as your contribution margin 1. Second thing is EBITDA. EBITDA is also very simple. For EBITDA, what you do is, again, you go back to your P&L and you look at, okay, what other expenses am I employing? So here, if you look, they have subtracted the employee benefit cost. Employee benefit is basically the salary you pay to employees. Finance cost is basically the interest you pay to the bank. Depreciation and amortization cost, which is basically the wear and tear. Depreciation is not a real expense. It's not like money is actually going out from my pocket, but I'm still accounting for it because all of my assets have a finite lifespan. So I subtracted this, and there are some other expenses, which are 2,000 crore. This could be your other expenses, administrative costs, all of that other stuff. If you're interested, you can read more in note number 30. Now, These guys have already done all the subtraction, and you come get this number called 3,883 crores, because all your expenses add up to 54,000 crores, right? So this is your number, but we don't need this number. Why? Because here we have already subtracted finance cost or your interest and depreciation. So we need to add that back, because we should not subtract that for EBITDA. For EBITDA, we consider earnings before income, earnings before interest, tax, and depreciation. Here we have already subtracted interest and depreciation. So we need to add that back up. So simply from in 3.8, I will add 0.8. 0.82 होना चाहिए वैसे तो. How is this 0.82 coming? 0.7 and 0.5. Very clear? I'm the decimal places I'm using, मैं 3,000 नहीं कर रहा हूं. I'm just saying it as 3.8. I mean, it really doesn't matter, right? So this comes out to, because we're going to be dividing it at the end of the day. So 3.8 plus 0.8 gives us 4.6. I have taken 4.7 just to give you a little more, like to be on the safer side. 4.7, and that divided by 58, that gives us 8%. So this is the calculation for EBITDA. So this is how we get EBITDA. Okay. We've already seen gross profit, DMart 12.5%, EBITDA 8%. Finally, let's get to net profit. Net profit, you can calculate the easiest and the fastest. Net profit के लिए simply P&L में जाना है अपने को, और P&L में जाके ये नंबर ले लेना है, लास्ट वाला नंबर. Yep, this number. This is their net profit after they've accounted for everything. They've subtracted tax, they've subtracted some other stuff also. So approximately 3 है ये. That's what I've taken here. 3 by 58, which is 5.2%. So at the end of the day, they get 5% for themselves. Clear? Why do we compartmentalize profits in 3 forms? That's a good question. The reason you compartmentalize is because it gives you some understanding of how to look at a business. What do I mean by that? Gross profit tells me in a dream world, I would make this much money, right? Why is that important? Because if the underlying economics of the product is not good, like if the gross profit itself is very weak, say somehow the gross profit was coming around 5%, तो मैं ये बिजनेस करूंगा ही नहीं. क्यों? क्योंकि अगर मेरा ग्रॉस प्रॉफिट ही 5% है, अभी तो मुझे इसमें इंटरेस्ट भी देना है, अगर मैंने उस पर टैक्स भी देना है, मुझे डिप्रीसिएशन भी अकाउंट करना है, तो मेरे लिए बिजनेस अच्छा नहीं होगा. सो gross profit tells me basically the economics of the product or the service that I'm in, right? So a higher gross profit is very important. Now, then we consider EBITDA. EBITDA is the up. Now you might ask, okay, gross profit, I understand. It tells me the economics. Net profit, obviously, I understand because it's the money that I get at the end of the day. Why EBITDA? EBITDA because some of these expenses are not real expenses, right? Depreciation and amortization is not a real expense for you. तुम बस उसको अकाउंट कर रहे हो, पर तुम्हारी जेब से नहीं जा रहा है. So it helps to isolate it and think of that business without that expense. Same for interest. Interest you're only paying because you got some money from the bank. If you had put in your own money, you would not be paying interest, right? Same for taxes. Taxes, one can argue that you could set up the same business in a different geographic location and you can get some tax benefits there. You can pay some lower tax rate. So it helps to give you, okay, this is the picture for EBITDA, where I exclude depreciation, interest, and taxes. That's the reason why we have these 3 different profits: gross profit or gross margin, EBITDA, and net profit. Question: if the data is publicly available, why does actually have edge while trading on their trading on their last legally edge? I could not understand your question, Neeraj. Can you come again? Please tell some lesser known AI tools for finance. Lesser known? What's wrong with something being more known? I don't use a lot of AI tools. I use Claude is your go-to for everything. Yeah, you can customize if you want a bespoke financial product. Say hypothetically, you want a financial tool that analyzes treasury bonds, different kinds of treasury bonds from across the world, analyzes them for their rate of returns, etc. I can generate that as a project in Claude instead of getting a new tool for it, right? So, okay. Neeraj, are you asking your question again? Cool. Does marketing or let's say acquisition cost goes before CM2 or after CM2? That's a good point. Let me also cover CM2. I did not speak about CM2. The reason I did not speak is because I forgot. also I don't like CM2 personally. I feel like it's just एक तो इतना jargon already हो गया है. मतलब you will forget a lot of these things because it's not easy to kind of grasp everything in one day in one go. But CM2, simply put, it's called contribution margin. The reason it's called contribution margin is because it's the money that you can contribute to recovering your fixed costs. So we already know CM1 is basically your gross profit or profit in a dream world, simply by subtracting the cost of goods sold. That is CM1. For CM2, you just subtract all the variable costs, which is exactly what I've written here. You simply subtract all the variable costs. What are variable costs? Variable costs are your, you know, I mean, anything variable, electricity bill, it varies from month to month. Your employee cost could be considered variable, etc. Right? Like, but then there are also fixed costs. Actually, what I spoke about is mostly fixed costs. But variable costs could be something else, right? It could be commissions that you pay on the product, etc. Anything which varies or scales as the more units you sell is called variable cost. Fixed cost is something that doesn't scale with the units that you sell. So if you're paying lease for your office and you're generating some software in that office, now doesn't matter if you're selling 1,000 copies of that software or you're selling one copy of that software, your rent will be the same. So that's your fixed cost. Variable cost could be something else, right? So you just subtract the variable cost and then you get contribution margin too, which is the amount of money that then goes to kind of contribute in recovering your fixed costs. That is the way you look at it. Again, very complex. ऐसे तो तुम बहुत सारी चीजें बना सकते हो ऐसे इसमें और भी बाकी concepts हैं, but if you want to know, because some random Shark Tank will like to flaunt, some shark will like to flaunt their finance knowledge and asks founders, can you tell me the CM2 of your business? And then that person will be like, CM2 to nahi pata, sir. But that's basically what it is. Doesn't really matter. All right. So we know the 3 bits now. So far, so good. You guys getting a good primer for this is all MBA 101. This is all the stuff you will cover in your first term, and this will come up again and again. And this is so fundamental that it kind of becomes part of almost any business conversation in your career later on that you will also have. If annual data is publicly available, Neeraj says, why would one buy or sell same stock? Now, that's a good question. I don't know if you've come up with your own question, if this is your original novel question, I would like to highlight to you that you're tapping into one of the most fundamental concepts in all of finance called the public market hypothesis, or the idea of markets being fair. What does that mean? A fair market hypothesis basically means if everyone in the world or efficient market hypothesis, thanks, fair market, efficient markets, tomato, doesn't matter. The idea there is that if everyone has the same knowledge about all finance of a publicly listed company, the price should be the same and there should be no edge. You should not be able to make any money, honestly. Only new information will kind of change it. And that's obviously not true. There are papers that have kind of, it's largely true. I mean, so markets are efficient or in long run, they're not efficient in short run. There could be events that happen suddenly that some people know and you don't, maybe because you're following news, maybe you're following some of my reels, Microsoft just launched Solera, etc. You assume that these things will be nice, this hardware will go viral, I'm going to buy Microsoft stock today. Before this news becomes more viral, then a Varun Maya makes a reel about it, suddenly many people low, and now the stock is kind of rallying up. But because you bought it earlier, you will make more money. But if the markets were efficient, the moment something becomes publicly available, it is in public's knowledge. Vaibhanshu really logged in during the finance class at Yeah, I mean, I like learning. A lot of this also happened on my own, not so much in the classroom, but I will not shy away from giving credit to my finance professors. Professor Abhinav Anand. Oh my God, Abhinav Anand, if you take his class, his guy is a genius. He's too good. He is too good. Yeah. So where were we? We were answering questions. Efficient market hypothesis has happened. So Neeraj, I hope that has answered your question now about the reality of why efficient markets hypothesis is not true in short term. There are always some small nuances that you can get in if you deep dive it more. Also, think about it yourself, right? Like all this thing that I'm telling you now about reading profit and loss statements or balance sheets, anyone can Google and read it now, but people won't, and they just won't because it's not easy, it's not trivial. Only if you're kind of versed with this landscape will you understand it. I feel like since you've had an MBA and a McKinsey experience, you are able to facilitate the session really well. But in case someone doesn't have a finance background, they might lose you. Okay, thanks. Thanks for the appreciation, and I will try my best to not lose you. You can feel free to ask anything. Oh, there's a hand raised. Okay. Yes, please, Sarah, go ahead.
So I had a question. We looked at the Steamart balance sheet and we said that it is like a very strong company based on their, like whatever it is, right?
Yeah.
We are calculating the gross profit. It is coming around 12%, right? And the net profit is almost 8.
Yeah.
My question is that the, like, from personal finance perspective, 12% is like the return that stock market gives us, right? 8% is like what FD gives us. So why would I have like whole business and all this thing, right? Like what is the point? Like what is the point that I'm touching here?
That's a good question. That's a good question. So this is also some idea about, so when earlier we spoke about retained earnings, right? If you go into balance sheet, you see something called as retained earnings, which is your other equity, which is the money that the company holds. An argument that people make, which is exactly your argument, is if I can get the return on the money, which is the same as your profit, why should I let you have all the money? It should be given back to me as dividends, and the dividends should be then employed and us. So that's a fair question. I mean, if you ask from a personal finance point of view, why should I make a company like DMart and not just invest in FD? The reason there is, I mean, it's not straightforward, the answer. I'm going to be honest with you. Because although the finances are, you would see that there is a net profit of only 5%, not even 8%. 5% is your net profit. There is benefit to having a business. You can scale business, you can kind of compound it over time. You can do something similar with FD as well, but inflation occurs, but inflation will also occur for this as well. But if you have a business and you're kind of owning property, plant, and equipment, the property, plant, and equipment will also appreciate in value. There is also always an argument to be made that a company can pivot and invest that money in something else, which will generate them more profit. Fixed deposit is guaranteed to only give that much return. And this 5% number is the number that you're seeing right now when DMart has become like a mammoth. It's a huge organization with 57,000 crores of rupees, right? But when they were smaller, this number would also be higher because the economies of scale feel such, like even if with Walmart, etc., the bigger you become, you're okay having a smaller margin, positive smaller margin, because the absolute value still is pretty big. Also, scaling such large businesses is tough. In earlier days, the growth must have tremendous. Yeah, and the founder of DMart also put in a lot of his own money to kind of set up the facilities, etc., right? And one may also argue that, so now, if okay, leaving finance aside, if I were to talk from a strategic standpoint, now that DMart has a big play in the grocery space in India, and they are one of the biggest players, and they don't have any rent costs going up, etc. What they can do is they can start with their own in-house brands, where they sell the in-house haldi, they will sell their in-house other masalas, all of that, instead of selling someone else's product where they have less margins. Exactly to do what you're speaking, which is to say they increase their profit margin because they can get higher margins in something that they're selling it themselves. But the reason they're able to do it now is because they've reached a certain, and they're already doing it. DMart has their own spices and all of that. So the reason you can do that now is because similar to Amazon Basics. Thanks, Yagnesh. So there is an argument to be made there that once you become big enough, you can, even though your profit margins are similar to the rate of return in a public market, you have greater opportunities to invest the money and experiment and come up with alternate product lines which will enhance your business. Okay, I hope that answers. Kafi cool, Kirt. Batao, kafi cool. Your hand is raised.
Hi, am I audible?
Yes.
Okay. So continuing along the lines of DMart as an example, how we are going through PNL and discussing a lot of interesting things about the company and how it's scaling. What I want to understand was that considering the fact that the core of the business is something which sells, something which is perishable in nature, how do you think having so many units all across in a country like India, and of course, these different establishments are in different states with different climates and different conditions. So, do you think that such a model, at the end of the day, would initiate cost in terms of maintenance, then revenue, which is why that 8% sweet spot is not something which we can expect because it's more of a volume business when compared to a revenue or a pricing sort of a business. What would be your take on that?
Yeah, so I think there are two parts to your question. One is when DMart scales, now that it has scaled to all parts of India, how does that kind of tie together with their business model? It may be difficult to kind of scale to other difficult geographies and all of that. And the second part is that it's a volume game and not really a margin game as such. Second part is, I think, spot on. Any like grocery or retail player obviously will not have big margins, right? Because they're just the middlemen. They're really not producing stuff that you're buying, unless it's like their in-house product, in which case they have high margins. But otherwise, it's just a place you go and buy, right? So the value that they're generating is kind of aggregating all the things for you to go and buy, and that for that, getting a 12% gross margin is good enough. I would say it's nice actually. The second thing is in terms of scaling, right? Which is the first part of your question. There, the key answer is basically so if you look at DMart's journey, it's actually going to be a very long conversation. But DMart, one of the really good things that they did is they did not scale rapidly. They started initially with only a very few stores in Maharashtra. And then they really looked at the business model, trying to understand, can we make the balance sheet good enough so that individual store is profitable for us? Because if the individual store is not profitable, and if you scale this model, it becomes a catastrophe. You're investing more money to scale, whereas you're losing money in the existing stores and all of that. So once they perfected the business model, only then did they start to scale. I would really urge you to go and read the annual report where they talk a lot about strategy. We're only going on the numbers because it's a finance for builders class, but the strategy, they highlight what their roadmap so far has been on in what years, which stores came up, what their vision for the company really is in the next 5 to 10 years, how do they see making more values and all of that. So that's the answer, right? Now, I think we'll also have to move because it's 3:20 and we haven't even finished the first module. But you can drop your questions in the chat and I'll kind of answer. I think I've answered all right now. I don't see any raised hands and nothing in the chat also, so it's good. Okay, let's carry on. We have done profit and loss. Now we're moving. One thing which I also wanted to show you before we leave is to give you a flavor of our good old Apple, right? This is the balance. This is the P&L for Apple. Now for Apple, if you were to do this, again, very simple this time compared to what DMart had, their gross margin is 69.2 divided by 143.7. You can see the numbers highlighted is around 48%. Isn't that crazy? Almost half, 50%. That certainly answers Sarah's questions of why should I be an Apple and not invest money in FD? Because no FD is going to give you 50% gross margin, right? Now, 50% gross, and Apple is like famous for booking and getting all of the profits for themselves. So 50% gross margin, then you have EBITDA, which is around 35.4%. Then the calculation here, and then you have net profit, which is around 29.2% or around 30%. 30% net profit. That's insane. No wonder at one point in time they were the most valued company in all of the world. This is insane. This is like amazing, honestly. Okay, that's that. Let's come to the final bit. Cash flows. This should be fairly fast. I really don't enjoy cash flows too much, if I'm being honest. Like the cash flow statement, because but by the way, it's important for a business. I'm not going to undermine its importance. The core thesis here is that, okay, you can have a business which is generating profit on paper, it's profitable on paper, but you still don't have cash to give your suppliers, to give your like other people, right? And how can that happen, you may ask me? Well, because of multiple reasons. If you look at cash flow statements, essentially there are three main parts to this cash flow statement. The first bit is something called operating cash flow from operating activities, which is this bit. The second bit is cash flow from investing activities. And the third bit is cash flow from financing activities. Very self-explanatory in terms of their what they stand for. Operating activities से cash flow आना मतलब जो तुम on a day-to-day level कर रहे हो, उसमें से how much cash are you able to generate? There are some additions, there are some subtractions. It's slightly complicated to calculate, but we don't have to worry about it. Like you will see that there is this thing called adjustment for depreciation. What are they doing? They're adding it back in. Why? Exactly because of what we said earlier, right? Which is to say that this is not a real expense. It's not like cash is going out of your pocket for depreciation, but you still have accounted for it in your P&L. You said in your profit and loss statement that I'm going to reduce this cost of wear and tear, or I'm going to subtract this cost of wear and tear. But for cash flow, you will add that back in. You will have finance costs, which is in this case positive. So you're adding it back in, not always, need not be always. This basically finance cost comes from your cash flow from financing activities. What does that mean? Now, financing activities, you can either exercise some share options, You can do some lease liabilities. You can pay some interest on your lease. Basically, for financing your business, how much cash is kind of going out and coming in. What does that mean? Interest payments to the bank, interest received on any investment that you have, etc. That will give you the financial activities. For this purpose, I don't want you to worry about how it is calculated, etc. We will always get the numbers from a cash flow statement for any business. So let's understand more about reading it, right? So that's your cash flow from operating activities. You do some adjustments, you add back a depreciation, you account for finance, interest, etc., etc. You subtract your rent income, all of that. Finally, what matters to us are these three numbers. This one, and this one. What are these numbers? The first one is the net cash flow from operating activities. So from your operations, how much cash flow are you able to generate? It's positive 2,600 crores for DMart. Okay. The second is net cash flow from investing activities. And the third is this, right? So I'm talking about this and this. So cash flow in investing activities is negative 2,300. What does that tell us? That tells us that money is going out as investments. Why? Because DMart is expanding. So they are investing in new plants. कहीं ना कहीं उन्होंने एक नया दुकान खोला होगा, बड़ा मार्ट खोला होगा, उसके लिए पैसा गया होगा. So that is the 2,000 crore that is going. And finally, financing activities is negative 200. What does that mean? That means they're kind of paying out money as interest to banks, which is around 200 crores. Now, all of this is good. How do I read this? This is what you really look for, right? Which is to say, if your operating cash flow is positive, but your investing cash flow is negative, and your financing cash flow is negative, which is exactly what it is for us, right? We have operating cash flow is positive, investing is negative, finance is negative. This means that we're looking at a mature self-funding business, which is kind of returning its cash to shareholders. So you can think of Coca-Cola, you can think of DMart, etc. Right? That's exactly what's happening. You get money from operations. What are you doing with that money? Well, you're investing it back in to kind of get more plants up and running, and you're paying some interests as well. You can also have a case where your operating cash flow is positive. Yeah, I will do a cool down after cash flow. Yes, I'm also kind of tired. I need water. My larynx is drying up. Investing is negative and financing is positive. What does that mean? That means, yeah, actually, this should be intuitive to you. I should not even have this other things going on. If I were to ask you, if some company generates positive cash flow from operations, but is giving out money as investments and has positive finance, what does that tell me? I'll just wait for like maybe 10 seconds. You can answer in the chat. Yeah, expansion is the right answer. Asset heavy in future investments, that's correct. That basically means that they're raising money. If their finance cost is positive, मतलब पैसा आ रहा है कहीं से, right? How is that paisa coming? Mostly it's coming from either debt or they're kind of issuing new shares or diluting their own current equity. वहां से पैसा आ रहा है. Operating cash flow positive, that means business is profitable. They're generating money. Investing negative, मतलब वो पैसा कहीं ना कहीं invest कर रहे हैं नए assets में, नए buildings में. Aggressive growth mode, raising capital to invest, normal for companies. The question is whether returns justified. The third bit is operating cash flow is negative, investing is negative, finance is positive. This is all your startups. Cred, Swiggy, Zepto. Operating cash flow negative, मतलब loss making है. Operations में पैसा जा रहा है. Investing negative, मतलब invest कर रहे हैं. पैसा जा रहा है उधर भी. कहाँ जा रहा है? नए इन्वेंट्री बनाने में, कंपनी को एक्सपैंड करने में, नए ज्योग्राफीज में, एक्सेट्रा. फाइनेंस पॉजिटिव है, मतलब पैसा आ रहा है. कहां से पैसा आ रहा है? पैसा आ रहा है इन्वेस्टर्स से, वेंचर कैपिटल फंड से, कहीं ना कहीं से वो पैसा रेज कर रहे हैं, एंड देन दैट्स हाउ दे काइंड ऑफ गेटिंग इट. अर्ली स्टेज और डिस्ट्रेस्ड बर्निंग. लास्ट इज ऑपरेटिंग पॉजिटिव है, इन्वेस्टिंग पॉजिटिव है, फाइनेंस नेगेटिव है. इसका मतलब कंपनी प्रॉफिट मेकिंग है, कंपनी इन्वेस्ट नहीं कर रही है, पैसा अपने पास ही रख रही है, और कुछ पैसा लोन के लिए दे रही है. So it's basically selling assets to fund operations. Yep. Otherwise, how will you get money from investments? You're kind of getting something जो तुमने invest किया तुम बेच रहे हो, तभी तुम्हें वहां से पैसा वापस आ रहा है. So you're selling some assets. and finance में पैसा जा रहा है, इसका मतलब you're giving back as interest to banks, etc. This was always there for you to go look in this. Same thing you will see for Apple. Apple के लिए operating cash flow positive है, investing negative है, finance negative है. That means it's a mature company. आगे इन्वेस्टमेंट्स भी कर रही हैं फ्यूचर के लिए, कहीं ना कहीं पैसा जा रहा है इन्वेस्टमेंट्स में, ऑपरेशन से अच्छा खासा कैश फ्लो आ रहा है, और फाइनेंस में जो भी इन्होंने लेवरेज किया है अपने आप को डेट लेके, वहां पे थोड़ा सा इंटरेस्ट पेमेंट जा रहा है. ओवरऑल पॉजिटिव ही है. ओवरऑल आप तीनों को ऐड करके देख लो, ओवरऑल पॉजिटिव ही होना चाहिए. लाइक इफ इट्स नॉट पॉजिटिव देन यू कांट रियली रन अ बिजनेस. यू नीड पॉजिटिव कैश फ्लो, राइट? इफ यू हैव नेगेटिव कैश फ्लो तो बिजनेस ही नहीं चलेगा, तो फिर तुम्हें और पैसा कहीं ना कहीं से उठाना पड़ेगा. ठीक है. सो दिस टेल्स यू लिक्विडिटी, दिस टेल्स यू हाउ लिक्विडेबल अ बिजनेस इज. This is all that we have covered. Wow. DMart and Apple are our good friends. We will take some break. I will break, we'll pause for 5 minutes. You can take a breather, scroll some Instagram, I don't know, get some water. We'll start back at 3:35. And you can drop your questions in chat if you have any, Alan. So I'm also going to take a break. Hey, hi, Sukhjot. I just saw you in the list of participants. For those of you who don't know Sukhjot also helped me out with building the content for this module that you're currently seeing. Sukhjot is an IIM Calcutta MBA right now. He's in his second year and he's a lovely guy. You should definitely speak to him if you get some time later. Thanks for joining, man. Nice. All right. Okay. How are we feeling, guys? Is this too much? There's a lot of content. I hope the spirits are high. We can chill for some while before we start. Some of you are giving me individual DMs. I will not be able to reply, sorry. But yeah, the recording will be shared. And let's just look at the main thing. Out of context question: what's your favorite sector? One that you would love to operate, given my favorite sector is education. I'm a son of teachers. I love learning. I'm a curious soul. My handle is Vaibhanshu. So I just love this. This is exactly what I'm doing right now. As a sector, also, it fascinates me because I think this was the kind of context I gave before you guys signed up for Dhandha School in that audio that I shared, where I feel like as a sector, I don't know why coaching industries are booking all the profits where the value generated is very less. I mean, knowing what you know now, just by this 1 hour, I'll make an extended argument, but I can say that you can already kind of start reaching out to, some individual family offices, ask them that I would like to work as an intern in your place, etc. Because this is more real world oriented, right? Like there are a lot of things that you can do with this knowledge compared to knowing Lens law or Lorentz force, stuff like that, right? Which, don't get me wrong, I think it's very good to know. But the idea to crack JE, etc. is, but again, I'm going on the same rant. You guys have heard it, so you know it. Education is my favorite sector. I think it needs to be rethought. There needs to be more practical approach. But do you feel when you try to scale things in education, the entire thing is, yeah, I really don't know, Bran. You're right. I mean, it's difficult to scale. Education in India is very outcome oriented. You need to assure people jobs, etc., for them to sign up and all of that. And how does this model work in other cities? How do we target the masses? There are a lot of unanswered questions. Agreed. This is probably will probably make for an extended conversation for a long time. But that's my favorite sector. It gives me joy. It gives me happiness, and I like doing it. Can you give an example of a bad balance sheet? It's a very vague question, says Amit. I mean, everything in commerce depends on one or the other thing. Let's say building world-class hospital chain is a good business, but if you do it in a country like Iran, like the war is going to become, he's directionally correct. What he means to say essentially is it's hard to say what is a bad balance sheet without understanding what industry you're in. Always to kind of see if you have a fortress balance sheet or a bad balance sheet is to kind of look at the numbers for your current ratio, for your debt to equity, for your current asset base, etc., compared to your peers and compared to different points in time. This is really what you're looking at. And if you see strong correlation, if your numbers are better compared to your peers, you have a good balance sheet. If you have worse numbers, you have a bad balance sheet. But there is not a universal example. It depends on the industry. It's going well, bro. Learned a lot of new concepts. I used to avoid reading balance sheets, numbers I know. Now I can handle balance sheets. Let's go, Rachit. That's really all we want, honestly. Apart from the crowd, what differs you? Apart from the crowd, what difference you see in tier 1 and tier 3 B schools? A lot of difference, yeah. I think tier 3 B schools, everyone which is like not the top 5 or not the top 10 B school is kind of preying on maybe even 20. Well, I can make a case for maybe 20, but definitely the tail end of B schools are just making money in the insecurity of people of not having job and thinking that they will get a job straight out of MBA, which is honestly not going to happen. If you just graduate with an MBA from a random college, you will probably only be in debt and nobody's going to really signal a lot. It depends upon which community you're a part of, what access you have to the network, etc. Okay, what time is it? 3:38, maybe 2 more minutes of just random stuff. The content is great, just would need to brush up post the class, but finance has never felt this easy. Thanks, Lavanya. That's the idea. Out of context, what's your favorite sector? Okay, that we've already answered. Are any YouTube handles you follow religiously? Religiously. Vertasium? I love him. The whole his journey, and now it's a VC backed channel. The way they dissect science problems and make it so easy to understand yet very detailed is just incredible. I wish something similar happens in finance, and I want to do something similar. It's going to be a long journey. I mean, he did it over 10, 15 years, but that's one channel I follow religiously. There are others also which I don't follow religiously, but I quite like. Excurbia is one. I like his writing style. You can search for him on YouTube. EXCURB1A. The way he writes, the way he narrates is incredible. It's mostly philosophical and existential content, but it's still nice. MKBHD is really good. Simplicity in his videos, minimalism to the point, and latest tech. Amazing. Can you give an example? Sab ho gaya. Questions. I'm currently preparing for case comps as I'm A or B case books. Both of them are good enough. I think both of them are really equally the best. It doesn't really matter. Also, any couple of advice for case competitions. Ask your seniors who have won previously to share their decks. You can kind of get a lot of ideas from those decks, and you can recreate a lot using templates that already have worked. Any business-driven education company has not been great. Let's say Byju's, etc., where content-driven or emotion-driven brands like Physics Wala thrives. Sure, good insight. Uh, Personal brand led education brands definitely signal more credibility because you know the person, you know what they stand for, you know what they've been through, etc. So, and YouTube is probably very important to scaling education brands. So I agree. The session is going great, but can you please speak in English when you teach? I will try, but somehow English just keeps, at least when it comes to teaching, it just comes more naturally. But feedback taken. What are the things which indicate a fortress balance sheet? I think we've answered it multiple times now. Question: borrowings and balance sheet more than quarterly cash flow from operating. Okay, borrowings and balance sheet more than quarterly cash flows from operating activities. How does this affect the business? So when you say borrowings and balance sheet, it depends upon what kind of borrowings you're referring to. If you're referring to current borrowings, which are payable in the next 12 months, being greater than the quarterly cash flow, being greater than 4 times the quarterly cash flow, then it's probably a cause of concern because your yearly cash flow is not coming up with your current liabilities. But if not, then it's fine. And even if it is, you can kind of look at your current assets to see if you can kind of dilute some current assets. If your current ratio is healthy, you don't need not worry too much about it. But both of these things in conjunction, a poor current ratio and poor quarterly cash flows, can together be a cause of concern. What will I learn about business from an MBA that I won't if I continue building my father's startup? Again, depends upon what your father's startup is. If your father is building Anthropic, you probably don't need an MBA, but your father is not. If he's still building something incredible in a different sector, it's a company which has reached a significant scale, probably you will learn a lot in just shadowing your father. But if your father is working in an MSME, etc., there are a lot of things that an MBA will give you exposure to, especially a good MBA from a top tier college, which you will not have otherwise. So I have answered it based on the different assumptions. 342. I think we should keep moving. Our future cohorts are going to be about finance. Future cohorts, there are a lot of ideas about it. I don't just want to have online sessions. Want to try something in person as well. There also needs to be, there will definitely be cohorts on other verticals as well, not just finance. Finance was the most tricky, most tough. I wanted to tackle the most stuff first and see if there's demand for that. Um, then there's going to be about marketing strategy and all the other things. And going forward, the lens I want to really take when it comes to building Dhandha School is how can someone build a business themselves? Whether it's a small business, doesn't matter. But what's the process like and how does one get help all along the way? That's really the core problem statement. And we will try to build modules around that. I wanted to see for myself first how this experience is, how susceptible and receptive people are before I start conversations with investors and try to figure out how to scale my team, etc. Because right now it's mostly a one-man operation with help here and there from other people, but that's not scalable. Obviously, we'll need more people, etc. So in future, the vision is to make it a business school which is affordable, online first, yet has physical components that helps you scale and build everything from scratch, build a business from scratch. Follow those two. Would there be any future sessions on understanding business models? Yes, this is definitely in store. Claude or any AI is now doing this. How can exactly? I see AI is going to help you. That's a very standard question. How can AI and these sessions, etc. I mean, you really do still need an educator to kind of help you guide along the way. And the best is when that educator uses AI themselves so that they can help you understand it much faster with real examples, real analysis. So it's really a tool. It's not a this or a that. Why the name Dhandha? Like I get it very straightforward. I personally like the name Dhandha. I think it's a very catchy name. Clearly tells you what this is about without me having to tell anything. Dhandha School is teaching you to build dhandhas. So instead of thinking about Think School, which is a good name now that it's become popular, but Think School can be thinking about anything. What am I thinking about? Dhandha makes it very clear. It's about business and it's about businesses that work in real world. Question: tips for community building. Be yourself. You will attract others like you over time. Okay, there are a lot of questions now. Let's start. Yes. Okay, one more thing, how to get good at articulation. Speak a lot in the mirror, looking at yourself. Okay, so good break. I hope you got some nice refreshments. And now we will deep dive into the second part. So let me go to stock market basics. Very simple module, this one, and very practical. This is the kind of knowledge you can flaunt to your father also, or your uncles or other people who, this is like a very middle-aged thing. Stocks mein invest karna hai, mutual funds mein invest karna hai, etc. And this is not directly related to you building a business, but it's definitely something that you should just know. Let's start with the very basic assumption or like the heart of everything, which is Nifty 50. you would have seen, sorry, I was just reading comments. You would have seen that this number Nifty 50 gets spoken about almost every day on finance channels. It becomes a talk of the town when it falls. But what does it really even mean? And what do we mean by Nifty when we speak about it? Essentially, some of you might already know, Nifty basically means the top 50 companies in India by market capitalization bundled together to kind of make an index. Now, the performance of that index will signal how the stock market overall is doing, right? The idea there is, okay, stock market is a big game. Everyone, all of these companies are different players in this game. I will select the top 50 players from this game and make one index out of it. Now, if this index itself is doing bad, which is to say the top companies are doing bad, likely others are also doing bad. So the performance of the index tells me the performance of the market. Now, how is that index calculated? The formula for that is basically current free float market cap divided by the same thing in the base year 91. Before we understand this formula, we need to understand market cap. And what do I mean by that? Market cap, you will be surprised. This is actually a test I have done with someone who has been an MBA from IIM Bangalore. One would imagine to know what market capitalization means, but they also don't know what market cap means. It's the most fundamental thing in finance, but it's not very, or at least as well known as it should be. Market cap basically means, let's not write MC, let's write market capitalization full. Market capitalization basically means your number of shares, it's going to be very simple when you read it, into price of your share. Now, basically that means it's called number of outstanding share, number of share, doesn't matter. So if one share is trading at 400 rupees, hypothetically, and there are 1,000 such shares that a company has issued, the market capitalization of the company is 400 into 1,000. That's it. That's all there is. And this number is also the value of the company. It's the real value of the company because at the end of the day, market capitalization literally tells you how big a company is. And the way Nifty 50 decides which are these top 50 companies is simply by looking at the top 50 companies by market capitalization. Once again, very simple thing, number of shares multiplied by price of a share. That's your market capitalization. Together will tell you what is the overall value of the company. Okay, now basis market cap, companies are divided into one of three tiers. You can have something called as a large cap company. Cap becomes short for capitalization, and you will see this across in stock market. Even when new mutual funds come in, they will be named as large cap mutual fund, multi cap mutual fund, flexi cap mutual fund, etc. Cap means capitalization. So large cap companies, these are companies with large market capitalization. So they will have greater than 20,000 crores of market cap, right? Then you have something called as medium capitalization, medium cap companies. Medium cap companies are companies with market cap of 5 to 20,000 crores. Directional numbers. And then you have small cap companies, which are companies with market cap of less than 5,000 crores. I'm writing it fast, so my writing might not be the best right now, but I hope it's readable, right? So market cap tells you the value of a company, number of shares multiplied by the price of each share. Depending upon how big the market cap is, you can classify companies as large cap, medium cap, small cap. The investor philosophy is you take more risk when you invest in a small cap company. Why? Because the company itself is small compared to a bigger company, which is a larger market capitalization. If something was to go wrong tomorrow, say, I don't know, maybe something else war breaks out, etc. Reliance is more likely to survive than a company which is much smaller, because the smaller company might just die because they don't have a lot of money. Reliance has retained earnings of several thousands of crores, so they can withstand a year or two of bad economic situation, right? So that's the idea. So this is basically your the up you go, the lower risk you're taking. And in finance, the return on an investment is a direct measure of how much risk you're taking, which is where the famous quote, risk hai to ishq hai, comes from. If you're getting more money from an investment, that means you're taking more risk. That's the idea, right? So what would that mean? That would tell me, by this logic, if large cap companies are low risk investments, my rate of return or the money I will make from the investment is also going to be lower for these companies. But the same thing, my rate of return will be higher when I invest in small cap companies, which is where you get this incentive or some inclination to invest in these small companies, because you will see the stock go up a lot. But the reason that is happening, and that works fine if the economic situations are good. From the year 2021, 2022, Indian stock markets were in a big rally. So you would see that stocks were going up across all sectors. Even the large cap guys were going, but the small cap guys were growing much faster because they were growing on a smaller base. So you would generate more returns if you invested in a smaller cap. But also the reverse is true. When Russia invaded Ukraine or when Iran war broke out, your returns or the companies that got stuck the hardest were the companies with small market cap, right? So market cap is now clear. Now let's come back to Nifty. Let me just take a quick glance at questions. Questions. Do the top 50 companies in Nifty 50 change with respect to their market cap? Yes, it's a dynamic list. It gets refreshed every once in a while, where if the 52nd company with the market cap breaks into that 50, it becomes then part of Nifty 50, and the last company will have to kind of move out. Question. Does cap relate to any of the sheets that we have discussed, or is it just share value? It doesn't come up directly on the balance sheet, but you can see it in, like, it ties to the equity value, the overall equity. But sometimes what happens is the equity, the retained earnings, like, so equity, if you remember, there were two buckets inside equity. One was paid up capital. Paid up capital is the money that we had paid initially when we were setting up the company. Sorry. The second is retained earnings, which is the money that was kind of kept by the owners or the shareholders over time. Now, the market capitalization from the formula number of shares into price of a share need not match that number, because it may happen that the market values a company more than its retained earnings, right? Tesla, for instance, had one of the highest P ratios. What is P ratio? We'll get to it later, but it basically is a ratio which signals you what is the price of a share divided as compared to earnings per share. If you don't understand it, don't mind it right now. But basically, what I'm saying is the number market cap can be much higher than the equity that shows up on the balance sheet. Okay. Large companies are usually at the saturation points. That's the low rate of return. Why? Yeah, they're big enough, so they can't grow so fast anymore. They'll continue to grow, but their growth is limited. Sentiment is involved. That's correct. SpaceX now is correct. Yeah. So I've read all the comments. So now let's come back to 50. Now, one important nuance from a technical standpoint that I want to highlight is when you consider market cap, not just any market cap, it's called the free float market cap that you really look for. What do I mean by that? So let me actually draw the company. So this pie chart. Can I use a pen stem? Pen will look better, I feel. Boom. Let's go with blue. Right. So you have this pie chart kind of showcasing the equity of a company, right? This is the overall equity of the company. Or we'll say it's the market cap, which are not the same, essentially, that we said. Market cap is the value of the company on the share market, price of a share multiplied by total number of shares. Equity is what shows up on the balance sheet. But for this purpose, you can assume it to be not the same. I mean, let's just assume it's a market cap. Yeah, it doesn't really matter. Let me not confuse you guys more. Say it's market cap. Yeah. So in this market cap, some of these shares are going to be with the company's promoters. What are promoters? Promoters are the guys who started the company. So if I'm looking at Reliance, the promoters would be our beloved Mukesh Bhai Ambani, Dhirubhai Ambani, who's now dead, but other Ambanis, basically. All these guys will be the promoters. right? Then you will have some part of that share being held by institutional investors. What are institutional investors? This would be a Goldman Sachs or some other wealth management firm or a bank or a VC or etc. Some big entity that is invested in this, some institution. So you have institutional investors. Then you will have some part of the shares which are traded in the share market for retail investors like you and me. So we can go and buy, when I go and buy a share of a company, I am only kind of trading in this part of the pie, hypothetically speaking. This other part of the pie is with institutional investors. They are not selling it right now. And the other part of the pie is with the promoters. They're also not selling it. There is only a small part of the overall market cap of the company, which is getting traded on the free market or on the stock market. Now, by that part, what are the top 50 companies that will make for 50-50? So it may happen, hypothetically, it may happen that an Adani, it actually was the case, some of the Adani companies, before they kind of diversified and made other companies like Adani Green and Adani, all of that, a lot of that equity was sitting with the promoters of the Adani group, the Gautam Adanis of the world. They were not trading it on the public market. So even though the company itself was large enough that it would have been a part of the top 50 companies in India, it was still not part of Nifty 50. Simply because the free float market cap, free float is something which is freely floating in the market, something you can trade in on the stock market, was not big enough to be part of that top 50. Okay. So you look at, and this is very nuanced. I feel like a lot of people who would probably do an MBA would also not come into the fact that this is not just any market cap, this is free float market cap, but now we know. So current free float market cap of the top 50 companies, and you divide that same thing by 1991. So when the stock market became liberalized, उस समय अगर मैं टॉप 50 कंपनी लेता और उन टॉप 50 कंपनी के by free float market cap, if I were to take, what was that overall number? I take that as my base and I divide today's top 50 companies free float market cap by that number and I multiply it by 1,000. So if I now see that this number is 24,000, what does that really tell me? It tells me that compared to the market cap of top 50 companies in 1991, India's top 50 companies now have 24 times that much market cap. That is how much we've grown in the public markets. I'll say that again. Compared to 1991's top 50 company market cap, if the number Nifty 50 is 24,000, that means we have now grown by 24 times for our top 50 companies free float market cap. Okay. As this number goes up and down, we see it. This is like the trend line, blah, blah, blah. So attention, recording will stop in 2 minutes. You can re-invite into continue recording. Is that so? I thought I'm on the pro plan, bro. I paid for all this just to get more participants and more recording. I don't see any notification for record. Are you
No,
guys
this
seeing?
is Vivanshu. This is for Rupanjoy's personal
Oh,
assistant.
Rupanjoy sounds like a you problem again. Doesn't matter. Let's continue. You can rejoin. I will accept the recording invite if you want to record it for yourself. Okay. So Nifty 50 is done. We now understand what this number means. We also now understand how it's calculated. We also now understand what market cap is, right? Just a quick recap. Market cap means number of shares multiplied by price of each share. It's the value of the company. When I say a company's market cap is 35,000 crores, it is the same thing as me saying the company is valued at 35,000 crores. They're the same thing. Market cap is available for publicly traded companies because it's on the public market. But for private companies, we don't know the market cap, right? So there you kind of employ methods of valuing a company in other discounted free cash flow methods that I spoke earlier. Okay, so that's on market cap. Nifty 50 is the index of the top 50 companies in India by free float market cap, which is the market cap that is freely getting traded on the stock market. The number 24,000, 25,000 basically means that compared to the base year in 1991, it has grown by 24 times. All right. Nifty 50 is super clear. And the same way, the same principle is applied to other indexes. You have another index called Sensex. Sensex is for some other different companies. You have another thing called The only thing that really changes is how you shortlist a company. You also have Bank Nifty, where you're just looking at top banks. You also have Nifty Next 50, which is, say, not the top 50, but after that, what are the next 50 companies? What is their free flow market capitalization compared to that base year multiplied by 1,000? You have any index basically uses the same philosophy. You use a filtering mechanism based on market cap on a sector, on a different thing, etc. But you get some companies and then you compare them with a base year. In the US also, you have something called Dow Jones Index or S&P 500. S&P 500 is similar to how we calculate it, but it's a little more nuanced. And Dow Jones is like their own treasury and federal committee kind of decides that, okay, now we're deciding from each sector we will get these many players so that क्योंकि ऐसा हो सकता है कि टॉप 50 कंपनीज आर ऑल ऑयल कंपनीज हाइपोथेटिकली स्पीकिंग सऊदी अरेबिया में हो सकता है हमारे यहाँ पे भी रिलायंस एंड Adani doesn't do oil work that much, but let's say these are big companies, simply because the scale of this infra is so big that they come up in a Nifty 50. But one may argue that you also need other companies from tech. You need the Infosys of the world. You need the Servam AIs of the world to also be part of the index to kind of show you the whole economy. So Dow Jones take care of that. Okay, now let's look at an individual stock. We're going with the biggest company in India. This is the company with the largest market cap in India called Reliance Industries, where the bad boys, the Ambanis, have made the biggest killing, the true businessmen. I don't know how much more I can hype them, but basically this is it, right? So Reliance Industries. And I'm putting a screenshot instead of just using a recording or like a concept because this is what you will see on your phones, on the app. Let me just explain this to you real quick. On the top left, not that you need knowing, is the logo of Grow, right? Which is the brokerage app. Okay, I'm getting a little tired now, but I'm trying to make this more fun. So in the stock market, you will see this graph, which is the graph of how it's getting traded. This is the stock price. Next to it is how much it has changed in one day. It has gone down by 1.4%. Okay. Anybody can tell that. What's the big deal? This is probably more interesting. Now you look at something called as an overview. Overview mein sabse pehle you will start with, so this is, I took the screenshot today morning. So you will see everything 00000. This is because today is a Sunday. And if you didn't know, markets don't operate on Sundays. Only people who are too excited in life do something meaningful on Sundays, like having a class, and who don't have a life. But so this is why this thing is 000. But on a normal day, you will have some other value. Next is performance, which shows you today's low, today's high. Today's low is, who would have guessed? Today's low, the lowest price of the stock that it was getting traded at. So it was 1,305. The highest point it reached, basically, if you look at the graph, this bad boy right here will be around 13.05. And maybe this is the highest. So that will be around 13 point. I mean, not point, 1338 and 1305. That's the 52-week low. 52-week low. Who would have guessed why 52 weeks? Because surprise, surprise, in a year, there are 52 weeks. So this is 1 year low and 1 year high, just to give you some trend of how it performs. The triangle that you see tells you exactly where the stock is right now at the time of closing. Also very simple, nothing too crazy here. Now let's look at fundamentals. This is not simple, but for us it's simple, but it's what we really want to understand about a company, right? This is again the same thing, open price, close, previous close, live volume. This is the total amount of shares which got traded today. So by the way, live volume can be greater than the overall number of shares of a company. Why? Because the same shares can get traded back and forth. Then there are some circuits, lower circuit, upper circuit, not the circuit from, bad joke, but Munna, and this circuit basically tells you what is the lower bound or the upper bound for the exchange, for the stock, which is set by the exchange. So as to avoid volatility after that. Now let's come to the market cap or the fundamentals. First thing you will see is the market cap, which for this bad boy is 17,71,882 crores. I don't even know if I can imagine that much, but that's the market cap for Reliance. In US dollar terms, it will be 177 billion US dollars, assuming 1 rupee is 100. I mean, the other way around, $1 is 100 rupees. So that's number one. Number two, this is something which will get talked a lot, which is your price to earning ratio. इस पर थोड़ा हम टाइम स्पेंड करेंगे because a lot of time price to earnings ratio can tell you almost a lot of what you really need to know. Let me just take questions before when invest when investing in the Nifty 50, do we segregate our money in equal part in all the 50 companies? Okay, you want investing in rice? The way you kind of structure your portfolio, I'm just going to spend 2 minutes here because this is, by the way, in case this ever goes to SEBI, etc., by law, one is required to kind of give a disclaimer that this is not financial advice. I'm not going to tell you the individual stocks you're supposed to invest in because you need a license for it, etc. But from a first principles builder's perspective, here is how you might structure a portfolio. In a portfolio, you will have some part. First of all, do not go for, at your age, unless you've really mastered the market, do not invest in individual stocks because that's a very risky investment. Instead, invest in mutual funds because mutual funds sahi hai. The way mutual funds is kind of structured, again, depends upon the sector. The best thing to do is have, let's say, 20 to 25% of your portfolio in large cap mutual funds. Some SBI will be the fund manager. They will have some large cap mutual fund. You can invest a lot of money there. Then you can follow it up with other mutual funds. Medium cap a little bit if you have risk appetite. I would say avoid small caps. You can, if you think a particular industry will perform better, say real estate in India or maybe infra in India, given that India is growing a lot and there's a lot of development happening, at least on the infra side, you can buy a mutual fund which kind of just go to grow, type infra mutual funds, etc. You get a bunch of mutual funds, invest in that. Have at least 20% of your portfolio in metals, gold and silver. Gold mostly, silver is also doing really good. Okay, so rule of thumb: 20% in gold and in metals, gold and silver. Another 10 to 15% in debt. What do I mean by debt? You can buy debt on stock market. So an HDFC bank will also issue debt as on the stock market. It's called a short-term debt. You can just go buy it. It's very similar to FD. You have a short rate of returns like 6-7%, but unlike an FD, you can take it out at any given point in time. So it's highly liquidable. You don't need to have a fixed duration. Okay. So just go to grow, type HDFC short-term debt. It will come up. So these banks also issue debt. They raise money through you. So if you buy their debt, you're giving them money. They use this money to kind of fund their activities and they give you 7% in return. So another 10 to 15% you can put in debt. The remaining 60%, which is very large number given current economic standards, you would probably want to have lower number, but I would historically go for 60% in equities. Within equities, 50% in mutual funds. Large cap, medium cap, different caps by different industries. 10% could be your risk capital. This is capital that you're taking the moonshot bet, right? There you can, if you have some individual stocks, if you feel Zomato is doing good, etc. I will plug the charger. Thanks. If Zomato is doing good, etc., then then you can invest in an individual stock. But I would say don't invest more than 10% of your overall portfolio in individual stocks. All right, that's all the investing in advice you need to know. Mutual funds, do you invest in US stocks? No, I don't invest in US stocks. Financial services typically make up the largest chunk of Nifty 50. What risk does this concentration create for someone investing purely via Nifty index? The risk is actually not that high because banks make the backbone of an economy. So you would assume that if banks were to fail, everything will fail downstream because they're the ones giving loans, etc. So the risk is that the banks might fail, they might underperform. But that's if that happens, a lot of other things also go to shit. So that's what's up.
I'm so sorry to interrupt in between. This is a follow-up to the question which I asked
Yeah.
with regards to um, financial services typically making up like largest chunk of Nifty 50. So say if you want to have a balanced out portfolio in the longer run, you know that banks are not something which will give you the highest returns. So yes, they are likely to give you the most consistent returns. However, if you are investing, say something in, like you mentioned, defense or real estate, because India's budget is something which really um, focuses on developing these areas as the economy moves further down the line, and like really investing in these sectors. So don't you feel like if you have a properly studied and like a properly distributed segmented portfolio, it's going to be better for you rather than just investing in Nifty 50?
I think I agree to everything that you said. You're spot on. Um, exactly right for what you said about banks having a upper cap in the rate of return that they can offer you, because the business model is very simple, right? Like you just take money, give money. That's banks.
Mhm.
Uh, it's a safer investment, yes. If you want to,
Mhm.
if you want to have like a lower risk appetite, you would want to invest in banks. But if you have a good market or a sector thesis, whether that's defense, real estate, etc., you have players scanned out, you have funds kind of scanned out, etc. Yes, it's a good idea to invest in them because you will get higher rate of return, and that's really investing. Banks is just kind of like putting your money in and ensuring that at least even when worst comes to worst, you have some amount of your money kind of growing so that your overall rate of return is still positive. So that's, yeah, I think you're spot on. Um, Okay, missed
Okay.
starting 1.5 hours. Can you please share recording? I will share recording. And welcome, Amitesh. You're very welcome. You said that we should avoid small cap. However, for someone in early 20s, don't you feel that risk-taking capability is a lot more? And once can make quite a large sum of investing after properly being aware of sectors and companies. I agree, but oh, this is you only, right? Yeah. So I think we've already answered it. Yeah, you're right. In fact, your risk-taking appetite should be even higher to invest in yourself even before you invest in markets. So if you put the same 1 lakh in getting a camera and starting a YouTube channel, the odds of you making the return of a lot more is higher compared to that company doing well. Just a thought experiment, but I would say at an early age, it's always better to invest in yourself before. But it's not a bad idea to start. If you have a market thesis, you can still make a good amount of money. All right, what about ETFs? ETFs are exchange traded funds. For those of you who don't know, it's another financial instrument. There is going to be a bunch of, we're not going to deep dive into all financial instruments. Banks love to come up with different entities to kind of sell, trade things, etc. Exchange traded funds, for those of you who don't know, let's say if I were to buy silver, how do I buy a silver or gold on Grow? Because Grow is a brokerage app. They trade in stocks and mutual funds, right? So you have these things called ETFs. So you can buy a gold ETF or you can buy a silver ETF. Actually, I was thinking maybe for this, it's not a bad idea to show it on Grow, right? Actually, I'll show it at the end. Let me just finish the price to earnings bit and before we come to it. But essentially, ETFs basically mean if you want to buy gold or silver and other stuff on the stock market, you can buy it through a silver ETF. The way it works is the value of that ETF is pegged or attached or tethered to the value of the underlying asset, which is in this case is gold. So if gold value goes up, ETF also goes up linearly. So you can just buy a gold ETF, and effectively it's almost the same as investing in gold. But unlike investing in real gold, having to place it somewhere or having to place it in gold locker, a gold ETF, it's highly liquidable. You can buy it and sell it on the same day, just by a click of few finger taps on your phone screen. Any newly launched EGR? Any take on newly launched EGR? I don't know what EGR is. Please tell me. You know that we should have small. I think we have covered all that. For market cap computation, which price should one consider for multiplying? Because the number of free shares, because price keeps fluctuating. Yeah, you take an average. Price keeps changing, which is why market cap also keeps changing. The value of a company is not stationary; it keeps fluctuating. If you want an average, you can take a price average of the last 3 months, etc. Electronic gold receipt launched by NSE. Oh, okay. Yeah, I don't have a perspective on that right now. We just want to probably later on we can discuss this. Okay, price to earning. Let's get back to here. This is the most, if you have not paid a lot of attention now is a good time to maybe take a sip of the coffee. ठंडी हो गई यार ये, मतलब गर्म हो गई. Price to earning basically tells me what is the price of a share compared to the earnings that I'm getting on the same share. So the way you calculate it, exactly how I spoke, price of a share divided by earnings per share. Price of a share you will get directly from the stock market, so no biggie there. How do you get earnings per share? How do you get earnings per share? Again, very simple. You take earnings, which is essentially your net profit or the last line item of your profit and loss statement, which is your net profit, and you divide it by number of shares. This gives you the EPS. Right? So you get earnings per share, which is your overall net profit divided by number of shares. And using that earnings per share, if you just divide it by price of a share, you get a P ratio. Well, okay, great. Now I know what a P ratio is, but what does it tell me? It tells you for each rupee of earning on a share, what is the price, right? So if the PE ratio is 18, hypothetically, that means for every 1 rupee that I'm making per share, I am okay to pay 18 rupees as premium on the price of the share. Now, this might be slightly counterintuitive. One may imagine that whatever money I'm making as earnings per share should be the value of the share, or in other words, the PE ratio should be 1. If I'm making 1 rupee on a share as earnings, I should get 1 rupee as price of the share. Well, sure, in an ideal world, it should be the case, but people assume, or the whole market is kind of built in this hypothesis, right? Called the market hypothesis about what this company will do in future. Someone will imagine that the PE ratio, the direct implication of a high PE ratio means that there is a lot of sentiment of the market that this company future में फोड़ेगी. कुछ तो they will do something amazing for which I'm okay paying a premium. So if you look at insane companies, right, like Tesla. Tesla is the example that I would love to give here because Tesla was an automobile player. Automobile players historically had a PE ratio of, say, X. I don't know the number exactly, but let's assume that this is 50 or 5 or 8, whatever, a small number, right? Or I can just Google it. Let me just Google it. Let's give you a real number, in fact. Ta-da. PE ratio of automobile. Yeah, so average PE ratio, at least in India, is around 30 to 36. But for US auto sectors, it's around 33. So let's assume it's like 33, right? 30 मान लेते हैं. So typically, for an automobile industry, we assume a P ratio of 30. The market has kind of made its peace कि अगर इनको इतना रुपए earnings में मिल रहा है per share में, 30 rupees हम extra दे सकते हैं per share के लिए. अब now you may argue, how does that number come? Why 30? Why not 15? Why not 25? Why not something else? It's an equilibrium. We have reached this number over years now. Initially, when Ford would have come up with the assembly line in 1920s and this stock would have gotten traded, तब लोगों ने इसको कुछ क्रेजी प्राइस किया होगा. They would have not known कि भाई कैसे कितने लोग कार चलाएंगे फ्यूचर में. कार के लिए तो रोड भी चाहिए और भी इंफ्रा चाहिए, तो ये तो नहीं चलने वाला, घोड़े ही चलेंगे हर जगह, एक्सेट्रा एक्सेट्रा. So people will have different models, people will have different theories about how the world will go, and accordingly they will have their own willingness or propensity to buy something, right? Now, if more people want to buy something and less people want to sell something, which is to say demand is greater than the supply, the price will grow up. Similarly, if more people want to sell something and less people want to buy something, the price will go down, which is to say supply exceeds demand. Simple laws of economics, supply and demand. Everyone knows this. So these PE ratios of 30 for an automobile sector have come through decades of this industry being traded on the stock market. So everyone has kind of agreed कि 30 मोटा मोटा P ratio होना चाहिए. Now some companies may have 35, some companies may have 25. Why? Because one may assume कि Hyundai को थोड़ा ज्यादा देना चाहिए क्योंकि Hyundai has a strong presence in the Asian markets. Volkswagen has not been able to capture India. Their market sentiment could also be कि India में automobiles का market will be the fastest growing market in any other country compared to any other country in the next 20 years because discretionary income is going, and the company which has the strongest hold in that market, aka Hyundai, should deserve a higher premium. So the PE ratio will reflect as a higher, right? So, but still, mostly it would range around something like 30 to 40, right? Just by reading PE ratios, you can understand the market sentiment for a stock. A higher PE ratio means the market is bullish, or which is to say that it is saying that this stock will perform better. By the way, this two-word bear and bull is very common in the finance landscape. And the way these languages, this term comes is because a bull uses his horn and kind of attacks like this. If you see a bull attack, so bull will always attack like this and it will take you up. It's going to push you up and boom. A bear is going to slash you down. It's going to take that punja and so when a stock is going to go down, we say that there is bearish sentiment. When a stock is going to go up, we say that there is a bullish sentiment. Probably the only funny, comical thing about all of finance, at least they got some animals in, they had some anecdotes and not just some capital allocation models and all these terms that a normal person doesn't understand. But now you will never forget it. Now you know what bear and bull means, right? So for the industry, you have a PE ratio of around, let's say 30 to 40 for automobiles. Just by looking at a PE ratio, I can understand if the company is doing well or not. Because if a higher P ratio means the market thinks it's going to perform well, a poor means it's not going to perform well in the future. Tesla was an anomaly because at the height, Tesla's P ratio was 3 digit compared to, like, even right now, if I were to look at Tesla's P ratio, it is 365. Can you imagine? Can you even imagine this? 33 for industry peers and 10 times that for Tesla. That's because people just loved Tesla. Like they were like, this guy is going to do something crazy. No one's going to do that. Like the hypothesis there was, here's a guy, here's Elon Musk. This guy has done really well in the past. PayPal worked really well. He let that go, made a good amount of money. Now he's gone all in with Tesla. The problem statement he's tackling is the heart of everything, which is that electric vehicles need to come in the future. We can't be on fossil fuels all the time. Well, there are a lot of challenges with electric vehicles, but I'm going to do it the best. I'm going to invest a lot in engineering. I'm going to make the best world-class batteries. I'm going to have the best torque. I'm going to have the best, distance covered in a battery, etc., etc. And I'm going to make a car that's going to perform really well. And when that happens, and it's so surprising because this is a business case study which really needs to be like appreciated more. Here is an industry which has been there for hundreds of years. You have big players like all the ones, Volkswagen, Hyundai, etc., etc. A new entrant comes, and it comes with a market thesis which is very forward-looking and very tech-heavy and tech-savvy rather. And the market rewards it. The market says that, you know what, we really believe in you. We really think you're going to do something crazy or crazy kar dega tu. And you will, that's why you need a PE ratio of 350. That's why people are okay paying that much. Whether Tesla will kind of fulfill that, only time will tell. Elon has multiple times said it in his press conference that I feel like Tesla stock is overvalued. People are just too bullish on it. They feel like hum kuch crazy kar denge. But yeah, now BYD is also coming with some great electric vehicles, etc. But the story I'm trying to highlight is of PE ratios and how much can you tell? Simply by PE ratios, you can tell about the company and how well it's performing simply by looking at it. So now let's come back to this. You have PE ratio, price of a share divided by its earnings per share. You will also see some small thing called TTM. What is TTM? TTM is just trailing 12 months. पिछले 12 महीने. Because everything is, it could be a point in time, right? Price of a share तो usually point in time ही रहता है. बट अर्निंग्स पर शेयर तो डिफर कर सकता है. मैं कौन सी अर्निंग्स लूं अभी, लास्ट क्वार्टर की अर्निंग्स लूं या फिर लास्ट 2 क्वार्टर की अर्निंग्स लूं या लास्ट 12 महीने की लूं. तो दैट जस्ट मीन्स लाइक लास्ट 12 महीने की ले लो. तो दैट मीन्स पी रेशियो ऑफ TTM trailing 12 months, it comes out to be 18.5. Believable, normal. Yeah. Good thing is Grow also tells you industry PE right then and there. So you don't even need to calculate it. So you can see that for the industry as a whole, around 13.5 है PE. रिलायंस का थोड़ा ज्यादा है, 18.5, क्योंकि लोगों को लगता है रिलायंस थोड़ा ज्यादा मचाएगा. क्यों मचाएगा? क्योंकि मोदी के साथ टाइज हैं, ज्यादा बेटर इंफ्रा है, बिगर एसेट बेस है. देयर आर लॉट ऑफ रीजंस दैट वन कैन पुट फॉरवर्ड फॉर व्हाई दिस इज डूइंग गुड. Okay, so P ratio tells you that story. Now, debt to equity we've already considered. This comes directly from your balance sheet. You look at in your balance sheet how much debt you have and you divide that by the equity. You get this number. It's less than 1. Great. It's amazing. Now we have to, an earnings per share, TTM, ये तो simply यही है, उसका denominator ही है. So we also know this. Now we need to, on face value कुछ नहीं होता. Face value basically जब कंपनी सेटअप करते हैं तो उनको पेपर पे लिखना रहता है कि एक शेयर इतने रुपए का है. उसका वो बस फेस वैल्यू है, बस वो पेपर पे लिख दिया है और वो 10 रुपए ही रहेगा. 90% ऑफ द टाइम ये 10 रुपए ही रहता है. सो दिस यू कैन इग्नोर इट फॉर ऑल टाइम. इट्स जस्ट अकाउंटिंग थिंग. अब हम बात करेंगे PB रेशियो की, क्योंकि इसमें थोड़ा डिटेल में जाना पड़ेगा. एंड हम बात करेंगे रिटर्न ऑन इक्विटी का. या एंड आई थिंक दैट्स अबाउट ऑल यू नीड टू नो. ठीक है. पी रेशियो, एनी डाउट्स इन पी रेशियो? ऑल गुड, परफेक्ट. अब आ जाते हैं पीबी रेशियो में. पीई रेशियो तो ज्यादातर लोगों को, मतलब अगर किसी ने थोड़ा ढंग से पढ़ा होगा तो उसको पता रहेगा कॉमर्स वाले में. पीबी रेशियो इज नॉट सुपर trivial, but it is still very insightful, honestly. For that, let's understand this thing first, called the book value. The book value basically means shareholders' equity divided by total shares. So if you go back to the balance sheet now, यहीं पे है balance sheet. Cash flow ये तो. Yep. So balance sheet में मैं ये नंबर देखूंगा 22,000. This one. This is your overall total equity आ गई है आपकी. तो ये book value of equity है ना? Remember, we had a good 5-minute rant about how book value of equity is not necessarily the same as market capitalization of a company, because market cap में तो public में जो price चल रहा है stock का वो price चल रहा है. बुक पे जो आपकी इक्विटी रहती है दैट कम्स ओवर रिटेन्ड अर्निंग्स, साल बाय साल करते रहते हैं. सो दिस वी फॉर हियर वी ओनली कंसिडर्ड द बुक वैल्यू ऑफ इक्विटी, राइट? सो दैट इज द टोटल इक्विटी व्हिच इज 22,000. सो नाउ इफ आई वर टू गो टू स्टॉक मार्केट अगेन, so you get the shareholders equity, or I should just type it as book value of shareholders equity so that if you read it later you don't have any confusions. Book value of shareholders equity divided by total shares. ठीक है? Very simple. You get the book value of shareholders equity from the balance sheet divided by total shares. Then you get 668. Well, okay, great. Now I have 668 rupees, but 668 as P as the book value. What does that tell me? That tells me for every share, I have 668 rupees worth of equity kind of sitting there. Yeah. So that's like, it's like the book value of equity. It's basically the value of a share if I were to just look at the balance sheet, simply put. Okay. This is not true KZ, but PB ratio is where it gets a little interesting. PB ratio is price of a share divided by the book value of a share. Let's write it here. I think we might just be okay on time actually. 2 3 4 5 5 बजे 3 घंटे हो जाएंगे ना? Oh shit, no. No man, 6 बजे तक कर लेंगे. 6 से ज़्यादा स्ट्रेच नहीं करेंगे. Price, to be fair, I did give you all a fair warning in the email saying there's a lot of content to cover and I'm not gonna let any content go. So it's okay. If I mean, people are leaving as they go because people have a lot of stuff, etc., etc. And the recording will be shared, so no hard feelings. But thanks for sticking along. Price of a share divided by the book value of a share. Because the next edition is actually, the next module is my favorite, which is where we talk about VCs. This is technicalities, but it's important to know this. Price of a share divided by book value of a share, right? So now the book value comes around 668, price comes from the market. It tells us कि on actual equity, how much is the share valued at? This is a little more truer metric than PE ratio, because PE ratio में तो आप earnings per share देख रहे हो, यानी कि आप net profit per share देख रहे हो. Profit is a 1-year thing. हर साल एक profit आएगा, अगले साल आएगा, whatever. Equity is the actual money that owners have kind of kept with themselves, right? It's like the owner's own thing. So, and the book value of equity tells you book में कितना value actually. So dividing the price of a share divided by the book value, this should ideally be 1, because then you can kind of say that, okay, there is this is the total book value of the equity. This is the price of a share, and price of a share correctly reflects whatever book value of the equity means. But again, it's not the case. 1.96 है यहाँ पे, because there is a premium. Again, people assume that there is some forward outlook. Company is going to do better in the future. Equity is going to grow, etc. There's a nice, neat mathematical relationship called ROE into PB ratio is ROE into PE. ROE is what? It's your return on equity. Return on equity is what's a return? Return is basically net profit, right? Like net profit divided by your equity, which is your book value of equity, I guess. Let me just cross check this once. Should do this way. Yep, net income divided by average total equity. Yeah. So what this means is, for every rupee of equity, how much money am I able to generate? If it's 8.9% or 9%, that means for every 1 rupee in equity that I have, I'm able to generate 9%, or 9 times rather. Percent per 100 hoga, but like for every rupee of equity, I'm able to generate 9 rupees in profit. Well, that doesn't make sense. That should not be the case. One second. Huh? Usually, the way I use ROE is kind of it to tell me how good is an industry. So different industries have standard ROEs, and you would want a company with a higher return on equity. That which is to say, for every unit value of equity, it's giving me higher return. So in this case, if you look at yeah, exactly that, right? So, which is basically tells you, in case you haven't understood anything so far, forget I said anything. ROE means return on equity, which is your net income or net profit divided by book value of equity, which is an indicator of, for a unit value of equity, how much profit am I able to generate? A higher ROE is better because then I'm able to generate more profit for the same amount of equity. Okay, so here you see ROE is around 9%. This ROE is a very good kind of measure of what you were speaking about, Sarah, earlier about, okay, if I invest in an FD, etc., my rate of return, I can compare my rate of return with my ROE because that's my return on equity, right? If I'm buying the equity, my return is coming around 9% here. It's better than FD, but probably still not better as other things, right? And this figure you can look for a lot of companies. You want a company which has a greater ROE, as high as possible. The bigger the return on equity, the better, right? Okay, now to summarize, there are literally three main things that we'll discuss here. First is PE ratio, the most important. Price of a share divided by earnings per share. Price of a share is the price of the share. Earnings per share is nothing but your net income divided by the total number of shares. What a PE ratio tells me is how bullish is the market for the company. A greater PE ratio means the market has positive sentiment towards the company. A lower PE ratio means negative. Different industries have different PE ratios. Exactly. And you can also compare PE ratios in time. A good indicator for a financial bubble is often very high PE ratios. Because what that means, like with the case of Tesla, a PE ratio of 360 means the company is overvalued. The company, people are really too bullish on the company. So it's usually a red flag when PE ratios become very high compared to their peers. Okay, that's all on the PE ratio. Great. Next thing we discussed was book value of equity. Book value of equity is nothing but the equity that you see on the balance sheet divided by the number of shares. So on a per share basis, what is the book value of equity? Got it? Using that book value of equity, now you can calculate a PB ratio, where you divide the price of a share divided by the book value of equity per share. So you get a PB ratio. Again, it doesn't tell me much. It's very similar to a P ratio. A higher PB ratio means more positive sentiment. People usually don't even use PB ratio that much. सब कुछ PE से हो जाता है. But it's good to know what it stands for and kind of gives you an idea what PB means. Finally, there is something called a return on equity or an ROE. What that means is net profit divided by the book value of equity or the value of equity. Net profit divided by equity, that gives you a return on equity. The higher return on equity, the better. Perfect. And just there's also called a DuPont relationship, which is this formula. You don't really need to know it because it's not like you'll be solving CFA questions, but a PB ratio equals to ROE into PE. That's really how you need to read a stock. When I get to a stock, when I will look at grow, I will look at, okay, what is its PE ratio? I will look at what is it the industry PE. I will look at what is the debt to equity. I will look at what's the ROE. If I scroll more, I can see companies' financial right there. Simple things like revenue and profit, scale, this everyone knows. I can get the information on the man, the myth, the legend, Mukesh Ambani, the year it was founded in, what is the symbol. If I scroll more, I can get shareholding pattern, which is also not very useful for me because I don't really care who holds much. But if you want to go deep dive in the company, maybe it helps to know that 18% of Reliance is actually owned by foreign entities. Sure. And then you can also see what mutual funds it's invested in, or mutual funds have invested in it rather. Okay. So that's pretty much the real fundamentals of stock markets. Now we know about Nifty, we know about market capitalization, we know about P ratios, we know about ROEs, We know how to value how to tell if a company is overvalued or undervalued. We know where to invest, what kind of asset classes to invest. And we also know how to analyze a company purely from a fundamental standpoint, where we look at PE ratio trends with peers with time. We look at ROE trends with peers with time. All right, I'll break for a question. Yes, Sarah.
So we have the book value of shareholders' equity and like other earnings, right? Like which of them actually have the part which is non-promoter, non-FIIs? Like do we take only that section which is available to public, or there is no concept like that here? Because if you scroll to the right, like there was that 50% is with promoters, then there is FII,
Understood.
right?
Yeah. So for book value calculations and for your ROE calculation, the value of equity that you take, you do not care at all about how it is structured. You do not care whether promoters own it, foreign. You simply go to the balance sheet of the company, which is this one, and you take the number that comes up as total equity on the balance sheet. This is the total equity of the company. We don't care how it is structured. The only part where it becomes important whether it is free floating or not is in Nifty calculations. If you remove Nifty, for Nifty calculations, we need to consider, is this part of the equity getting traded on the share market or not, or if it's with promoters. But for ROE calculations, for PB calculations, you get the equity directly from the balance sheet. Okay, good question. Anyone else? Question: what other factors can create volatility in a stock of company? There are a lot of factors. It could be political instability where the situation of the country is changing. It could be technical advances in a new technology. Maybe if I'm a telegraph company, suddenly landlines get discovered, my business model gets a hit. So technical factors, political factors, you can have competitive factors where the business model stays intact, but there's a new competitor that comes to town that does better. Swiggy entry in Zomato's core business model. So there are a lot of things that can go wrong. It could also be management issues where the company is doing well, but suddenly there is a turmoil in the leadership, etc., and then you kind of suffer. Okay. Okay. That brings us to the end of stock markets. We have discussed all we really need to know for the basics of stock markets, and now you are a pro in stock markets. You really need, yeah, you will not be, you can play around a lot now. You will not be intimidated by any of the numbers that you will come across. All these calculations will be shared with you. This one will also be shared with you, and we have the annotations. I would recommend as homework to go and download random annual reports. Look at random balance sheet statements, random P&Ls. Try to see what current ratios they have. Try to see P ratios. Really use Claude for it. Don't just do it on your own. You have AI to do it. Ask it questions. Ask it, what does it tell me if the P ratio is this much? Is this the right definition? How would you pressure test it? What are the 3 reasons which would probably go against the current ROE value, etc., etc. Right? So have fun with it, and literally these are 100 video ideas for you. If you start a business channel, you can already make 100 videos about this where people have no idea, because nobody's really putting out content about the finances of Reliance, right? Nobody really knows what's really on their balance sheet. Nobody really knows why their ROE is better than others. This is conversation which any person in a top business school will entertain with you. So we'll take some break here. You've learned a lot. This has been very information dense. Thanks for sticking along. And after the break, we will start talking about the venture capital landscape in India. Now that you know all the basics of finance, now that these terms don't scare you, now you know what these terms mean, we will start talking about what do we do with this knowledge and how do we build our business decks. How important is DRHP? DRHP, for those of you who don't know, means draft red hair prospectus is basically a document that gets released before a company goes IPO or public, which details everything about the company. It is Bible of the company. It tells you their history, their shareholding pattern. It's like a 200-page document, honestly, but like everything. And it's important because SEBI demands it, that if you're going public, सारे पर्चे चिट्टे खोल दो अपने, मुझे सब बता दो तुमने अभी तक क्या क्या किया है, क्या क्या करने वाले हो, एक्सेट्रा एक्सेट्रा, एंड दैट बिकम्स अवेलेबल टू द पब्लिक. सो it becomes very tedious. It's usually an investment bank's job to kind of come and make that DRHP for you. It's going to be a long, tedious process. Even when done fast, it takes 12 months to make that document. That's the reason why companies want to go IPO, but they just can't go IPO directly, right? It's a process, and DRHP becomes a big bottleneck where you have to kind of make sure that DRHP is done properly. Boat has not been able to go to IPO. Boat is probably struggling with a lot of reasons. So that's DRHP. Let's drink our coffee. Hey, this was fun, yeah. I actually enjoyed it. Did you guys enjoy this? Is this fun? Can you tell me in the chat? Yeah, let's go. Let's go, Ansh. Absolutely. Oh, hard. Let him come. Let him come. Nice, nice. A useful Sunday. That's a good way to put it. It's much. And look at it. It's only $500. So I feel like at the end of this class, I will also ask you guys to see how would you value this course? Because this is an exercise in valuation for me also. I don't know what's the real value of this. Right? Like I just want to teach first. I want to interact with as many people, get to know feedback. But together, when we build Dhandha School, we want to know how it really works, etc. Anyways, so Cloud free version won't do this task easily. Buy the pro version. It's $2,000 is worth it, yeah. Bum. Buddy module 3, my favorite. Yes. Absolutely. You will have discounts for future cohorts. There's no doubt about it. With the founding members, bro. Yeah, I have all your emailing lists. So I will really hope that you guys keep coming back for these sessions that we have it. And we will price them more fairly. And others will definitely pay a much more premium. You will obviously always get maybe a 10 to 20% discount. Always. Ba-ba-bum. Shameless pitch because we're on a break. Till I'm not building something of my own. I'm looking for new opportunities. I'm a product and design guy. If you or anyone you know, I love that. Yeah, you can market yourself. This one is for Vibouncer too. I'll be great fit for your team. Well, thanks for putting yourself out, Gagan. How are we going to stay connected? I have your emailing list. I am also going to get a community manager at some point in time. So please make sure that you check your mails because right now that's the only. I also have your phone numbers through the Razorpay app that you kind of checked out. So maybe at some point I will also use that to WhatsApp and get back to you. But email and WhatsApp are going to be my channels to get back to you in the next few weeks after this cohort ends or this class ends. In my first sem in MBA, balance sheet was there, but the faculty was meh. So this is what I'm talking about. Yes, who's this? Costa, I feel you, bro. So finally caught up with what I have missed. Yes. Sarah says, Claude free version, invest in yourself. Absolutely. And how about joining you to build it like professionally? Man, I would love it. I'm trying to find out the finances of it because I only have so much money saved from McKinsey and I'm trying to like solve for my cash flows through YouTube and all of that. This life is good, but to build a real company, big company, there's going to be much more capital that's needed. So I have to find leverage and stuff. And honestly, like when you start investor conversation, shit gets real. And I also wanted to like take things on my pace. After I left McKinsey, it's important that I take the right steps at the right direction. It's a long game. It's a 10, 15-year game. It's important that I play it rightly and don't get burned out. And, anyway, but I have you guys. So this is amazing. And hopefully my vision is some of you, if not most of you, will go on to build great companies yourself and we'll all stay connected. And hopefully a lot of what that happens can be tied back to this day and the stuff that we learned. Okay, good things take time. That's correct. So suggestions. I guess everyone here is interested in finance. We can create a WhatsApp? By all means, go ahead. Drop me an email. I will drop you all the details of if everyone gives me consent. I will drop you the details of people, etc. And we can kind of have a WhatsApp group where you can, if you want, you can be the community manager. I'll also be active, and that way also you will have my personal number with you. Fools. This is helpful. Okay. Let me stop sharing my iPad now. Probably the first time I've used this bad boy at such length. Stop sharing. Yes. Also, yep. Yeah. 444. Okay, let's start with Okay, where is the okay, this is what I want to discuss, right? Yes. How do I do this screen share? You guys see a document called Venture Capital Landscape in India?
Yeah,
Perfect.
it's visible.
Okay, so now before we do anything, what I have done here is made like a database of all the venture capital funds in India that are active and everything you really need to know about it and how can you reach out and etc. So we'll go through this and I'll help you understand it also. But before that, let's assume you don't even know what venture capital is and how it works, right? Let's go completely first principles. Venture capital is basically a business model where there are these things called a venture capital fund, which is usually 10 to 15 people. These people get together, they raise money from people who have a lot of money, which is usually HNIs like Nikhil Kamath, etc. Or a lot of them are actually institutional investors, big institutions. It could be Indian big institutions like the banks, ICICI, HDFC, etc. Or largely it's actually foreign investors, which are based out of the US that are kind of giving money to these VC funds and then they deploy this capital in India. The goal of a VC fund or the business model of a VC fund is basically to, one second. Yeah, this one is basically to scan businesses and find opportunities or find startups where they feel there is a scope to get 100x, 200x returns, especially if they find it early, right? And the idea there is 90% of the businesses that they will invest in will fail. They know they will fail, but there's going to be one or two or five or very small number of businesses that will perform so well that they will give them exponential returns. That's the goal, right? So if you look at someone who was, let's say I'm Kevin Systrom. I'm the founder of Instagram. I am pitching my app. If some of you guys have seen my video about what the fuck is happening with Instagram, you might know the story. And Kevin Systrom pitches his startup to this guy called Andrew Horowitz. I hope I'm saying his name correctly, but Horowitz, basically. He was an investor, an angel investor, who gave him his first check of $500,000, right? Small check. $500,000, and he used that to build this other company, which was not even called Instagram back then. And then he pivoted really hard, and then Instagram became Instagram, and Horowitz made a fortune for his life, right? But the reason he could give that is because he identified and scouted this venture early, and he invested in it. He was an angel investor. VCs do exactly the same thing. So a life of a VC basically means talking and scanning the landscape for founders. Their literal job is to kind of search for people like you who are excited to build, who have an idea, who are coming up with new innovative solutions to real problems that exist and giving you money so that you can get access to resources that you need to build. And in the hopes that some of you will make something so massive, so big that it's going to justify their entire fund. That's the VC thing, right? That's the real VC play. I think I kind of summarized this in my pitch guide thing. Yeah. So this is what I started with, which is like the VC mindset, which is what every VC asks. Can this company return my entire fund? So for a 100 million fund, that would mean at least a 300, 500 million. By the way, the economics of a venture capital fund works in a manner where they have a credit cycle. So they start by getting the fund and then they have, let's say, 7 years to kind of, hypothetically speaking, this is usually the ballpark, 7 years to kind of return the money back to the investors with a premium. And this rate of return, again, going back to our concept, where if you're taking more risk, you want more returns. So they would assume that a VC fund will generate more than 15% returns at the very least for them, because lesser than that they can get by just investing in the index, right? In a country like India, Nifty only has been, I mean, barring the last 1.5, 2 years, Nifty only has been growing by 12 to 14%, right? So why would I invest in your thing if I can just invest in the public market? So you have to give me more returns, right? So in the 7 year, from the VC's perspective, I am getting money from big institutional investors, HNIs. I'm scanning and scouting the landscape for revolutionary startups, giving them capital at an early age, kind of nurturing them also a little bit if possible, and then trying to cash out my returns in the next 6, 7 years. Obviously, easier said than done. As I said, 90% of the businesses will fail. Things will go wrong. It's not easy to build a dhanda. There are 100 things that you need to take care of. But there will be that chance where something will succeed. And when it does, you will build a fortune. All right. So that's VCs. Some of you might already know this, but it helps to kind of go over it again. I talk about the return math here, which is what big enough matters so much, because purely from a number standpoint, like if they're looking at it works because someone will have to kind of give exponential returns, everything else will kind of fall. Before we go into the slide framework, let's actually look at the players here. Now, for players, the way I've kind of bifurcated this is by international funds and Indian funds. International funds have most of their capital coming from outside India. Indian funds have most of their capital coming from India. The first name that you will see in this list is this company called Peak 15, whose office is in Indiranagar, 5 minutes from where I stay. This company is I would say in many ways, the pinnacle of Indian VC ecosystem right now. Earlier, it used to be called Sequoia India. Now they've renamed themselves to Peak 15 Partners. The name comes from the 15 people who run this company because they're Peak 15. How about joining you to so are you planning to do something Mesa has done, sir? Okay, this is behind, so I'm going to let that go now. We've spoken about suggestion. I guess everyone here is in. Okay, 1 second. I'll just take, due to prior commitments, I'm unable to attend the meeting while the session will watch recorded. Sure. Okay. There are some people in the waiting room also. So I've admitted them. Okay, we can get back to it. Right. So we were talking about the players in the VC space. We were talking about Peak 15 and Sequoia Capital India, which used to be their name earlier. Now they've renamed it. The key people there are Shailendra Singh. So once you get this document after today's session, I would urge you to kind of just go and like see their LinkedIn, see what they've been up to, what it takes to kind of break into the scene, how their journey has been. All of them are incredible people. You won't find the likes of them on YouTube because they don't do the creative work, but in the business landscape, they're very accomplished. Very accomplished. So Shailendra Singh, then you have Rajan Anand. And Rajan, you might have seen on Nikhil's podcast also. Nikhil did a VC podcast with. So by the way, fun fact: I was speaking to Nikhil's fund manager. His name is Vivek. He recognized me on the streets while I was walking, and then we had a conversation about stuff. And it was very interesting to know how WTF fund actually works, what their portfolio looks like a little bit, and their workings, etc. Yeah, but just a detour. That tells me Rajan Anandan was actually on Nikhil's podcast, and that's where I know him from. You will also see the Bloom, which will come later on in this video. You will see some of them. So after this session, I would definitely urge you to follow these guys on LinkedIn. Just go follow, see kind of the stuff that they put out. LinkedIn, they're still relatively active, and you will get some good stuff. Now, next column is fund size and AUM. AUM, for those of you who don't know, simply means assets under management, which is the size of their portfolio, which is the sum of the valuation of all of their companies right now. So for Sequoia India, so these numbers might be directionally correct. Some of them might be off. Don't take them for granted. Obviously, I've used Claude to kind of compile most of it. So I've checked wherever possible, but if the numbers are off, I would urge you to go and check them. So they're not legally required to tell you in public what their AUM, etc. is, but most of them do. So this is where you're getting these numbers. The way you would kind of rank a VC is the biggest is the one with the biggest AUM. Then you have, yes, Karthik Reddy was also there. Yes, Karthik from Bloom was there. So you have AUM, decreasing order of AUM kind of tells you the decreasing order of scale for these funds. Latest raise, that's the kind of money that the VC fund itself raised, which is VCs also need to raise money, as we said. So this was their last raise. And India Seed plus Venture plus APAC funds. Key portfolio investments, Zomato, the poster child in many ways of Sequoia India's portfolio, right? If you have not read, there is this book called Unseen on Dipender Goyal, which is available on Blinkit. You can just order. It's a good read. It's one of the only business books that I've read end to end because I wanted to know like what has Dipender really done to get to where he is right now. So it chalks his journey out right from his undergrad days and his first startups and his struggles with Zomato throughout. And it's a nice read, honestly. And how one day, one email from Vivek Pichchandani, Sanjeev Bikhchandani, the big Sindhi, the founder of InfoEdge, Naukri.com, his email and his early investment in Zomato really changed the trajectory of Zomato. Anyway, I'm digressing. So Zomato is the poster child. Then you have Oyo, you have Cred. Cred, I don't like as a company, personally speaking. I feel like Kunal Shah is really, really good at raising capital, one of the best in the country, if not the best. But is the only entrepreneur that at least I know of amongst the big ones who've never made a single rupee in profit ever in his life across all these companies. He's never made money, not even a single rupee throughout his career. So he had Free Charge earlier, which was like a coupon-based service that worked well, got a nice valuation game, had a lot of VCs coming in, eventually sold it, was loss-making the entire time. And then the whole model went away because coupon thing didn't work out after a point. Started Cred. The premise of Cred is I'm going to give you, I mean, at least how I understand it. Kunal obviously will be able to explain it much better. That's how he raises capital because he sells aspiration. There's a lot to learn from him for me. But the way credit kind of works is you scan the top 1% of India, which has the highest buying power, the best credit ratings. You get a very detailed database of their transactions, etc. And then that data becomes your moat. You can sell this data to the banks. You can take care of the intermediary credit card recharge payments, etc. But again, it's a loss-making company. They tried a lot of things. They did credit points and all of that, but they've never made a single rupee. But their office is also in Indiranagar. It's like 5 minute bicycle from where I am. Right now, Meta is in talks to acquire the business. I did not know that. Well, that's interesting. I'm sure he's very rich now and he's going to be fine, even if Fed works or not. But I'm sure he'll be able to sell it at a good premium. Then you have Meesho, you have Freshworks, Byju's, Mind Labs, Ola, Swiggy, Browser Stack, all the companies that you have heard of. Sequoia India has invested in all of these guys. If you want to send Peak 15 your entire your company's venture, and you want to be like, I want to get some money from Sequoia India. How do I do that? That's the email address. That's their physical address. This sheet will be shared with you. You can just reach out to them. How do you build a deck? We will talk about the basics of that after we discuss this, and just kind of going over what works and what's like a sanitation factor for us. This last bucket is very important because you would want to reach out to this also came from so I was talking to Slick co-founder when I was at Scalar. And Slick, for those of you who don't know, is a fast fashion company. Their premise is delivering fashion in 10 minutes. He also he's consistently been raising money and is also a good founder when it comes to raising money. So I was talking to him about how he raised his first check and what do VCs really look for when it comes to giving you money. One of the key things that he spoke about is VCs have a market hypothesis for a particular sector. So it's important that you know which VCs to reach out. Don't waste your time reaching out to VCs that don't invest in the sector that you are working in. Know which sectors that they want to be going in. This is, broadly speaking, the sector focus for all of these funds, which is also important. So they do consumer tech, they do SaaS, fintech, deep tech. I don't know how many deep tech companies really are deep tech in India, but that's what's up. Health and ed tech. And their IRR, which is like, this is the gold standard. This is the main metric that one looks for, which is what rate of return they're able to generate. Sequoia has been able to get like close to 30%, at least on the top side. Then you have Excel. Now I'm going to up the ante a little bit, but we'll still go over all. Then you have Excel. These guys, Prashant, Prakash, nice name. Alliteration going well. PP. Total 3 billion funds. Fund value is 650 million since 2008. Flipkart. So by the way, Excel is like the big funds in the US, huh? Same with Sequoia. Sequoia is a US fund. They just have, this is their Indian arm. That's kind of what like SoftBank, for instance, you guys would know, is the Tokyo thing, the Japanese that invested in Oyo and stuff early on. They have this fund called Vision Fund where they invest. So you have Tiger Global, Excel key investments are Flipkart, Swiggy, Browser Stack, blah, blah, blah. You will also see that the same company raising from multiple funds. That also becomes like a trend in the industry. If one fund is long on you, they feel like you're going to do something crazy, other funds will kind of follow along. It's bhed chal, little bit, not a lot, but there is some sort of like, oh, if I get money from one guy, I know how to convince two more people because it's selling at the other day. Like you just need to sell your idea really well, right? If you can convince one big fund, the other fund will assume, like if I'm the MD of Excel, right? If I'm a partner, I would be thinking, man, if Peak 15 has put in some money, they must have seen something. They know something and they would have done their due diligence well. I'm okay putting in, so they put in. So you will see companies kind of come multiple times. You have Browser Stack. This is their email. They're an HSR, consumer internet, SaaS, fintech, seed to Series B. Tiger Global, this was the main fund behind a lot of Bain & Company's cases. The management company, Bain & Company. Management consulting company, Bain & Company. Too many times companies have said in the last two sentences. But this is the fund that was kind of deploying a lot of capital in India early on. Now, they've slowed down a little, but these are their marquee investments. And this is their AUM. So this is like, now at this point, we're just reading this table. So you can read it for yourself. Then you have SoftBank Vision Fund, Masayoshi Son, Japanese, blah, blah, blah. Warburg Pincus, again, a fund I'm not very well known, but also invests a lot in the financial sector. IDFC First, one of the few funds that are very actively looking for financial services players. Like a bank, this is not even a fintech player, it's like an end-to-end bank. Actually, IDFC First might be a different legal entity than IDFC Bank. I'll have to look into it, but basically that. Then you have Bessemer Venture Partners, again a fund which not very well known, but fairly active. 350 million is their fund too. Global AUM globally is pretty big. India, they have around 80 plus portfolio companies. This is their details, blah, blah, blah. Lightspeed, General Atlantic, Z47. This is a fund that when I left McKinsey, I had a cold inbound from them for an interview to kind of see if they want me as an associate, which sometimes happens on LinkedIn when you have these hiring agencies kind of like looking for ex-McKinsey and other consultants. I did not sit for the interview because I don't know if I'm ready for a VC yet. I want to build something, work as an operator before you go into this industry. But it's a good fund. Z47 is a very nice fund. Earlier, they used to be called Matrix Partner India. Avinash Bajaj is leading, the co-founder and MD. Would love to speak to these guys sometime and pick their brains to see how it works. But basically, fintech and lending, yeah, pretty big in fintech. That's kind of what they were looking for. Also does some consumer. Agri-tech is not actually pretty famous. They've written it here, but I don't think a lot of like agri-tech money goes in. They did some play initially, but it hasn't worked out really well. Temsec Holdings. So this is the top 10 funds in India which are international and everything that you need to know about it with the contact details. And don't think that, okay, these are big funds, they do like really big checks, which is true, but they also have like small arms within them that look for like very new ventures, search ventures, like very small checks also for like very budding ideas. So don't be shy. You can email all these guys with your decks, and I'm sure they will get back to you. Even if there's a reject, they will reply, very active on emails. Then let's talk about the Indian venture capital funds. This guy here, Bloom, is quite famous. Bloom's report is also very well read in the industry. A lot of difference between IRR and NPV, which is a better metric. IRR means internal rate of return. NPV means net present value. Very different thing. Net present value comes from discounting the future cash flows at the expected rate of return or the weighted average cost of capital, which essentially means net present value is essentially what value will 100 rupees or 200 rupees in the future be for today, right? It should be little less because if I have more money now, I can generate some interest and then make it more. It's quite a very different from what we're discussing, but I'm just going to answer your question. So that's NPV. Oh, my previous message was about IDFC First. It's a bank. Yeah, I figured that. And IRR is your internal rate of return, which is the rate of return that you need to justify for an investment, or basically the way it comes in handy is when you make investment decisions, your IRR needs to be greater than the opportunity cost of capital. What is opportunity cost of capital? It is basically the return you would have gotten if you were investing in some other investment. What is your opportunity cost of capital? And your internal rate of return needs to be greater. So that's how you use IRR. NPV is, as I said, is the present value, net present value of the future cash flows. I don't know how you came up with that question. It's pretty random, but okay, sure. I hope that answers it. So these are the Indian venture capital funds. You have Elevation, you have Nexus, Bloom, Kalari Capital. Kalari is not very, like, it has slightly a bad reputation right now within the industry for a lot of reasons. But yeah, also one of the only funds which is headed by a female. Not that those two events are correlated. I'm just saying. I really don't have a perspective, but I just wanted to give you facts, both of them. Yeah, so then you have 314 Capital, Staris, Kshetre. All these are again different funds. You can see some new companies pop up here. Mintra. You can see Grey Orange. I don't think a lot of people would have known of Grey Orange. Dhruva, Darwin Box, Postman, Ixigo. As a budding founder, it's also a really good exercise to just go. Like, if I were you, I would probably read, at least I would scan the company websites for all these companies listed here to kind of see, okay, what business models have worked and been successful for these companies, right? For these funds. That will give me some idea, because if I don't know what has worked before, it's hard to come up with something new, net new from the get-go. Okay. So these are the top 10 venture capital funds, which are Indian. India quotient is nice. I also like it. Okay, I think everyone gets this point. You have this document, so we can kind of move on now. But this is going to be probably one of the most used documents after this session for you. Now let's move on to the final bit of today's session. We are at well over 3 hours, actually just over 3 hours. We're going to spend maybe another half an hour here talking about what makes for a good deck and some sanitation factors, and we'll take some questions and then we'll wrap it up. right? Okay, this is a compilation of it, but essentially, actually, can I take a break here? I need a pee break. I will be right back. If you guys also want to take a small break, just be back. Mm-mm-mm. Hi, Coffee Cool Kirit. I think you want me to open that thing again? See what prestige was? Let's see. Ba-ba-boom. Ba-da-boom, ba-da-boom, ba-da-boom. Elevation, Nexus, Blue, Stellaris, Gray, Lightbox. I don't see any prestige. Yep. Waterbridge, India Quotient, Lightbox, Chitre, Stellaris, 314 Capital, Kalari Capital, Bloom, Nexus, and Elevation. Yep. And I don't think this is necessarily in a decreasing order of fund size because you can see that Bloom has probably the highest AUM. But yeah, cool. Okay, now let's talk about the final bit, which is how do you kind of construct the deck, right? Like if you want to build something, what is the lens that you want to look forward when you talk to VCs, and what's like the most basic sanitation factors that definitely need to be in your story for it to be VC convincing. So this is the checklist. Doesn't have to be 10 slides, but this is something which is like fairly well established now that you need to cover these things or majority of these things for sure. Uh, Before even looking at that, let me just talk to you about like what's really happening. You need to convince a person who has capital in the form of an associate in a venture capital fund that they need to give that capital to you. And what they're really looking for is an assurity, a really strong conviction that you will be able to 100x that capital. Now, obviously, what this means is the most important thing for them is to show the scale of the problem or the scale of the end state business solution. If you pitch them a very nice business, but at the very best stage also, it can only make for a $20 million business, they will not be very interested. For example, I'll say, if you go to a VC and you tell them that my father runs, I don't know, man, my father has a lifestyle brand in my city of Raipur. We run a shop which sells like a bunch of clothes. We're doing well, we're profitable, we are expanding with two, three more shops, etc. We want some VC money. VCs will not look at this and they will probably not give you money, mostly not give you money. And the reason for that is not because your business is bad. Your business, as I said, could be doing financially well. The only thing is they are not convinced that this is a scalable solution. What are you really solving for, right? Maybe you can say that you're providing best clothes in the city of Raipur. Sure. But then that also means that your saturation point is the city of Raipur. If you come to somewhere like a Bangalore, you will have West Side, you will have Zara, blah, 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 X number of retailers who will outbid you, right? So VC will not look at that. But on the other hand, you come up with something more fundamental, like hypothetically speaking, Dhandha School, where you're saying that the masses of India are business illiterate, for lack of a better word. There is a need for higher business knowledge. The unemployment is probably at an all-time high. The mindset needs to change, etc. There could be like a strong VC story that could be built that at the best case scenario, the outcomes could be similar to the physics wala or the physics wala. Or actually, better off, let's talk about physics wala because they've already done it. So physics wala, when they would have raised VC money, they would have probably spoken about how unanimously in India, people need to prepare for NEET and JEE. It's like the story that's sold to all of us. So the market is massive. The current players are this. They will have XYZ proposition. Ellen does physics well, hypothetically, or Resonance does something other well. They have good faculty, all of that. Here is how we differentiate ourselves. This is our play. We have state-of-the-art IPs on YouTube. We have the highest subscription. All of that they would have used to kind of build a strong story. But the point I'm trying to say is the heart of that pitch would have been how this problem is scalable to 100x. That is the story. Once you can give them a flavor of that, once you can give them the picture that this is going to make 100x returns in the best case scenario in the 10, 15 years, that's what's going to get them. That's really the heart of it, right? So this is important. I think I've kind of pushed this idea a lot. Now, how do you start with it? You start with a very brief one-line company purpose. It has to be as short, as crisp as possible. If you can't define your business simply, you cannot scale it and you cannot build it, right? So one-line company purpose for, I don't know, for physics wala or for Dhandha School, let's say, hypothetically speaking, a one-line or work in progress one-line description could be to democratize business knowledge for the masses of India. That's like a one-line process. Now, obviously, that doesn't cover everything, but it tells me the core of what the thesis at this company is, right? And that's important that whatever you build, you have that 1 or 2 line max version which can summarize your idea. That's point number 1. Point number 2, which is very important, the most important, in fact, in many ways, is the problem. And I would also like to add right next to the problem is this idea of the scale, the potential scale of the problem, right? Don't get me wrong. Problem could be very small and simple. It could be a very simple problem, but it should be a problem that should have the potential to become a massive business. Okay. I think we've driven this idea home a lot. So that's kind of what I'm also adding in this column here, where there is a commentary on what the VC is really asking. Is this a real problem people are desperate to solve, or is it a vitamin pretending to be a painkiller? These are the terms that VCs also use a lot. Vitamin pretending to be a painkiller is something which is good to have, but it's not necessary, right? That's what we don't want. A cred is a vitamin. Solution. Your solution is solution. I'm not going to read it out. Simply, what are you proposing? What is your business model? Kind of point number 3 and point number 6 tied together. Ties well. Right? Point number 4 is also very important, which is the timing aspect. You would be surprised how a lot of conversation actually hover around why now? Okay, sure, you're telling me this problem. I'm also to some extent also convinced that this is a problem which at the best case scenario will generate 100x returns for me. By the way, I would love to give you real examples, but if it was so easy to give you real examples that would scale 100x, people would be building businesses like that left, right, center, right? So I hope you can understand how it's not easy. But in hindsight, we can think of something like Flipkart or Zomato, right? Zomato, we can roll along with Zomato, right? The core problem when it started early on in its days, when it was just a menu card service, was that corporate people need good access to good food and they don't have information for that. That's the real problem. Across the corporate in Mumbai, Bangalore, Delhi, etc., in different offices, this is a problem that everyone faces. So it's scalable, sure. Now, funny thing is, Sanjeev Vichchandani, actually the reason he could write that email aage se, it happens very rarely when an investor reaches out to a founder aage se without even them doing anything, is because he was using that product himself back when it was called something else. It was not even called Zomato.
Foodie Bay.
Foodie Bay, let's go. Nice. Good job, Ansh. So Foodie Bay, it was called Foodie Bay, and he was using it himself. And his CFO at the time, Sanjeev's CFO at InfoEdge, he said, "Why don't you reach out to the founder? If you like it so much, you should reach out to him." And then that's how the conversation started. So going back to what's really happening, there's a one-line description for what Zomato was doing initially. There was a problem which was scalable to 100x, and there was a solution which initially was just menu cards, but obviously the initial model can look very, very different from the end state model. There could be multiple pivots in the way, but the vision or the lens from which you build remains the same. Okay, so that's solution. Why now is why now, which is what we were talking about, which is to say a lot of businesses you will see right now in the AI space, at least in the last 1.5, 2 years, are coming up because now we have these foundational models and people can kind of build some wrapper around on top of it, which can also be very useful. Specifically in the case of Indian law, where there were a couple of Indian law startups which were talking about the use cases of using these foundational models for lawyers and kind of helping them with the diligence, etc. The why now could be the story of why only now can such a business be built and not anytime before, is because a geo revolution has happened in 2016. Before 2016, the access to internet was not a thing. Then large language models have only come about in 2022s, and so right now is the real time to build it. If we don't build it, someone else will. So why now also has to be kind of very strong for the VC to be like, yeah, this is the time to do this thing, and we should really go in. Part number 5 is, again, it ties to part number 2, which is the problem of the statement business model we've already spoken about. Traction. I think before this, I mean, the rest I can read it out, but more than that, what will be helpful is if I could show you an actual deck that worked before for a company so that you can kind of appreciate it for yourself. And what I have for you guys is the deck for Urban Company back when it was called Urban Clap in 2014 when they raised their first VC thing. So let me just get that. So most of these decks are actually not publicly available. So there's always a question of whether actually before I show you this, I have yeah, I've kind of highlighted what I really wanted to drive home, which I've said multiple times now. But you can read this document also. Founder market fit, very self-explanatory. Why you? Why not someone else? There has to be strong conviction. If I were to give an example of, again, I don't have many examples, but say Vaibhanshu building in the education space. Why you and why not someone else? Could be, one may argue that there are some signals of caliber from top institutes, etc. in the past. So that can come in as credibility. I don't know. Right. So there could be some unique things for the founder, which helps you give an advantage over the others. For different industries, it could be different things. Largely, it comes from people doing some work in the industry for like a decade or so. That's where usually they build. Why now? The type of triggers, technology, regulatory, consumer, as we said, the UPI trigger. There are also some idea of like what not to say. Things like this obviously don't really fly. We want to be more precise. We don't want to give a very vague idea of this is what we want to do. We want to be more clear. This is what I wanted to talk to you about. So here I've kind of tried to collaborate decks that I've worked in the past. But when I checked all of these decks, some of them are good. Some of them I feel like are not good and are just probably someone else kind of making this deck and putting it up on Slidebean. So don't think that all of them are legit decks. But nonetheless, here is a repository of a good amount of decks from the past that kind of play in the same ballpark that we are building in right now that you can check out. So these links are always accessible to you. And you can find some other decks here. But a deck that I personally do like is the Urban Clap deck, which, and this at the end, there is some summary of everything, which is like what we are talking about. Now let's discuss about the Urban Clap thing. The Urban Clap thing is, by the way, I'm really impressed by your attention span, guys. Very nice. How does this guy go up? I'm trying to go up, bro. Just go up. Yeah. There you go. Okay, here is the deck, which seems, as far as I can tell, pretty legit from back in the time of 2014. This is when it was called Urban Clap. And the first is just a slide. You'll also see that in this case, when people talk about consulting decks looking beautiful and like that probably being important to raising capital, people with money really give more importance to the meat or the content than what it's getting presented. So don't worry if your decks don't look like the sexiest. As long as you have all the bases covered and you have a good compelling story, you're fine. They start with some form of a market hypothesis, which tells you, okay, service market represents a multi-billion space. As I said, open with how big an opportunity this is, right? This is massive. This is going to be a big thing. We're talking about how this billion-dollar opportunity really looks like. There are wedding and events. So you have photographers, makeup artists, you have personal services like sports and wellness. Essentially, they're kind of covering everything. It's kind of, is my video lagging a little bit for everyone? No, it's fine. Okay, great. I can't see the charts now, by the way. So in case someone is typing, I will have to. Okay, I see. You can see it now. No problem. Pitch deck hunt somewhat similar to product market. Blah, 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 blah. All right, we're good to go. Yeah. So open with that. Open with the fact that this problem is really big and there is a big opportunity for you to capture. So they start with these are the key categories. These are the representative services. At the bottom, they say we are excited about this market given its size of $15 billion plus broken nature and pain faced by customers and providers. This gets a VC hard because they look at it and they're like, wow, this is a big opportunity. If I can get this executed well with this company, I'm going to make like enough money to kind of get my fund up and running for decades to come. Okay, great. This is point number one. Point number two, by the way, only 19 slides. So you don't want to be coming to a VC with an encyclopedia of 55 slides. Keep it crisp. 10 is fine, 20 is fine, not more than that. All these non-standardized services are very broken in the market today. What are the needs? Some classic 2x2 for MBA to kind of appreciate. End customers, what do they really look for? Quality providers who are available and suited for the needs, some value for money, some tried and recommended for others. The problem right now is of discovery because that's word of mouth. That was the real play for Urban Club. They highlighted in bold, underline that word of mouth is the real game right now in India. That can be changed. Now, decision making takes time. Again, bold, blah, blah, blah. Simple words, short, crisp, bullet points. Nice. You look at a high quality, transparent marketplace is need of the hour, much like in other service sectors, travel, dining. One can agree. It's quite visionary, I would say. For 2014 times, where 100 people would tell you that, yeah, how will you put plumbers on an app, bro? What are you even talking about? What about electricians? We want to do everything. What will you do? Home service also will do. It's kind of like, it's weird. It doesn't feel very intuitively big business from the get-go. But when you put it like this, when you talk about the size of the opportunity being massive, when you talk about the need of the end consumers and the problems that they face and what the proposed solution is, it becomes much more believable. So the way they're kind of arcing the story is also important. All right. And they've talked to service providers, which is reliable access to the right kind of customers. They want transparent and flexible marketing channel. And they also want new business coming through as much as possible. There is also a lot of low utilization. That's the only kind of. So if I'm reading, I just need to read the bold and the thing. So I don't even need to read out the thing. I know that they want access to customers. They're underutilized right now. Okay, great. Current platforms not suited for matchmaking of these services. Again, highlighting the platform in detail. Same thing a little bit. Discuss photography. So there you can see that they kind of pivoted. Now they don't do photography play and all of that. But initially when they were coming up, it's still, they can shoot ideas and this is what they were considering. I'm not going to read everything, but just giving you a flavor of how the deck goes, right? How Urban Clap works, customer share requirements, you provide, providers choose and respond, and then customer has qualified options. Simple 3-step thing. I need this. This is what I can choose from. This is how I'll pay. As simple as possible. And channel between customers and providers open up, blah, blah. Insights from the market, some nice value chain going on at the top. I'm only going to read the bold. So word of mouth, as I said, time consuming. Online search is because of Google. It's shifting to smartphones now. Customers do not want to see a long list. They need hand holding. We want to see richer content, more profiles, more videos. There's a lot of mistrust. They need payment offline. Grievance mechanism platform should be there. Token booking. You can tell that this guy or this team has done their research well. They know the pain points. Same thing. Insights from the market. Middle layers, freelancers, blah, blah, blah. Continuing on. Launch categories. Now we're coming a little more into, okay, I'm on board with you. There is a problem. You've taken me through the problem. You've showed me what needs to happen. Tell me how you're going to do it. Okay, I'm going to target initially moms, young married couples, young women, because they're my demand. I'm going to use the frequency of use and only go for high frequency categories. I'm going to find hard to find categories so that our value proposition is maximized. Giving them some ideas of what I want to do. Maybe start with wedding and events. I'm going to start with wedding photographer, makeup artists, DJs, because there's a new age selected by the bride and the groom. Okay, personal needs. I'm going to give some salon service at home, yoga at home, nutritionist. Man, back in the day, this would have sounded so crazy, no? Salon service at home. Now it's so common. But yeah, kudos to them. So next wave of categories and rationale. Other personal categories to launch on similar themes. This is what my broader scheme looks like. I'm not going to restrict myself to this. Once it start working, I can maybe have fitness trainer. I can have music. I mean, the world is my oyster. Personal stylist, bartenders for house parties. They're just shooting ideas at this point, honestly, which is great. Not a problem. Gives you that grand image of what's possible, right? But at the same time, it's not, I mean, notice it's not ambiguous. It's not, this is not what they're starting. If they started with this, it would have been a terrible pitch deck. But the fact that you start with the problem and how big it is and what the pain points are, market research, and then follow it up with the timeline, this makes for a good flow. Next up, suppliers onboarding. We will find first 70, 80 providers, meet with them individually to ensure quality, understand category. We'll have a database. We'll have websites, blah, blah, blah. We're already seeing network effects play out. We'll have interim solutions, blah, blah, blah. Very simple slides, by the way. Just bullet points with text. But content is really good. User acquisition efforts. The decks these days look much better because of Claude and like the fact that there are so many ex-consultants and stuff like that. But I would still say like out of all the decks that I went through for this module, I really like this one more than the others. User acquisition efforts, how I'm going to acquire users, what is my CAC going to look like, how I'm going to do that. Oops, मैं पीछे चला गया. 10, 11, 12. Talk about the unit economics. What will my P&L look like? My average transaction value per request will be 7, 8K. I'm looking at number of bids per request of around 3. Give some this is, by the way, this is all what we've discussed, huh? So now we know our finance enough to kind of build a good business model which is convincing. We can tell people that, yeah, this is my roadmap to a net positive EBITDA of 20%. This will be my number of bids. This will be my percentage charge. Not very hard, simple, very simple calculations, but makes for a compelling case. Platform traffic. So now they're kind of like giving them more to latch onto to see that this vision will come to life. How will I make this a big company? I can expect 1 million annual revenue from 10,000 paying customers. When they see 1 million annual revenue, they might have apprehensions because how will you do that? But this number of 10,000 paying providers may seem more believable given that they have already spoken about the N number of channels they will do to kind of acquire users. Maybe by this point, the VC is kind of convinced that, yeah, I think you can get 10K paying customers. And if I believe that this much money that they will pay, I can see that you can get this much annual revenue. Already there's some conviction that is starting to build. Same thing chalked out in a time sequence, expansion strategy, and the bad boys themselves. Look at these guys, all really, really rich now. Abhiraj Bahal, consultant at BCG. Varun Khaitan, consultant at BCG. Again, two smart guys. Worked across India, SC Asia and Germany, blah, blah, blah. Giving some vote of confidence to the VC that they know their shit. They're not just anyone. Raghav Chandra. Raghav looks like this good angle, very interesting angle. Looks like Justin Bieber with eyeglasses. You can tell that he's the smart guy in the team. A software engineer at Twitter. In San Francisco, founded at boogie.in and IIT Kanpur alumnus. So helps to show that they were undergrad friends. That always helps. And bada bum, some backup if you need. Need strongly voiced during our extensive market research. This they didn't feel like was worthy of their final thing, but just to keep in case something came up. That's that. That's our walkthrough for the VC landscape. This is as much information as physically possible in 3-4 hours to kind of take you from the very basics of finance, who do not know anything about finance, building our way up, understanding the financial statements, understanding the financial matrix, understanding how businesses work, how to diagnose them, moving on to stock markets, understanding what stock markets are like, different fundamentals, what to scan for in a company, what to look for, then understanding the VC landscapes, the funds that exist, how to reach out to them, what sectors they invest in, Where are they based out of? What are the main people there? And finally, what makes for a good pitch and how can I make one? What can I learn, etc. We've covered all of this. This is the end of the first class of Dhandha School. People can unmute, you can do anything. Let's go. Thanks a lot for being together, being here. I really, really, really appreciate it. Don't leave just yet. I'm gonna share a form link. Please definitely do. It would mean a lot to me if you could share your honest feedback. Give me the review. If it was nice, if it was bad, whatever it was, tell me. I would love to put that up on my website for other people as well. Yeah, there you go. Let me just give you the link. There you go. Did you get it? Wait, not waiting room, brother. Go for everyone. Meeting group chat. Coffee cool indeed. Thank you. So you can fill your name, you can rate your today's class, you can leave the honest review. This is the part that will go on the website. If you want your picture, which I would really like along the review, you can add the picture. And if you have some actionable insights, something that we can do better going forward in the future, you can leave that here. We'll implement that. This is the feedback. I will be here for a bunch of questions for the time being. And I'll stop sharing my screen now so we can do our thing. Screen sharing has stopped, right? Yeah.
Not yet.
Not yet? Oh, okay. Never mind. Should be done now. Hey, everyone, especially Vabanshu. If it's fine, can we create the group and drop a WhatsApp link? Yeah, sure. You know what? Let me just add the WhatsApp group right now, and I'll just share the link here. So before you leave, you can just join it right away. I will also share it with others when I share the recording. And at this point, if it's okay, I'm going to stop the recording now. And already it's pretty long. So any other questions you have, I will be here to answer them, but we'll pause the recording now.